analyst, you have a much better feel for your borrower and what they face in the world of tax. The flip side, or the flip side of profitability, when your customer, your borrower is successful, which we want them to be, because the more successful, the more profitable they are, and the better they manage their finances, including their tax, the better they're going to be able to repay our loan. Well, but the flip side is they're going to owe more tax. There is a truism. Most business people in America would rather avoid the payment of tax. Most people in America would rather avoid the payment of tax. So the emphasis in sections 2 through 8 is tax avoidance, not tax evasion. I emphasize, and we're going to go in depth on some relatively advanced. Some of them are very advanced. Some are more basic tax strategies. But I emphasize that in doing the tax strategy section 2 through 8, none of these are tax evasion. Tax evasion is illegal. Tax avoidance is legal. Either way, you get to live in the big house. Well, what do you mean by the big house? Well, it's a slang term. Well, tax avoidance, you get to live in the swankiest neighborhood in your area. The swankiest. Jordan, I'm just going to ask you, what's the name of the swankiest area? You're in Grand Rapids area. You're right where Bob and Sue are in ABC LLC. What's the name of one of the swankiest neighborhoods in Grand Rapids?
East Grand Rapids.
Okay. All right. Good. Now, Dwight, what about in Jackson area? What's one of the swankiest areas? Dwight, if you're there.
Sorry, once we were just having a little trouble. I don't know, like it's not just one area, to be honest.
Okay, but just name one of them. Just one of them.
Chip isn't that bad. I don't know, like probably southeast Jackson, maybe, I guess.
Okay. All right. Well, if you avoidance of tax, you live there. Evasion, you get to live in the other version of the big house, which is federal prison, the federal prison, if you will. Absolutely. So we emphasize in these strategies legitimate tax avoidance and management of the tax, really managing from a business owner's perspective. Now, why do we do this? Well, it's once again to help you understand your borrower. A lot of times, your commercial borrower looks to you as if you are not just their lender, not just their loan officer, but they oftentimes look to you as if you are their financial planner, their financial advisor. Absolutely. Now, I do emphasize today's class is not intended to make you a licensed CPA or a licensed tax advisor. But that doesn't mean that when Bob and Sue, this imaginary couple, when you're at lunch with them or on the golf course or in their office or in your office, and they say, boy, we're getting eaten alive by taxes. We were talking to a friend of ours and they've done this strategy. What do you think about that? Have you ever heard of that? The idea here is to create added value for you as their lender, as their credit analyst. I'm going to tell you straight out. I've seen it from both sides of the table as a lender and now as a CFO working with these same clients that you work with, same type of clients. One of the worst things, in my opinion, for you to ever do is for them, Bob and Sue, to say, hey, we're getting eaten alive with taxes and we're talking to our friend and, maybe they're another manufacturer in the Grand Rapids area. And they say, well, boy, they're doing this strategy. Have you ever heard of that? What do you think about that? And you say, well, I don't know. I'm not your tax advisor. I'm your lender. Go talk to George. Go talk to George, your CPA. They're going to look at each other. In their mind, they're going to say, well, boy, he or she's not much added value, meaning our lender, our bank advisor in the back of their mind. The very next day, they're with your competition, the other banker down the street. And they say, oh, we're getting eaten up alive. And boy, we've heard of this strategy. What have you ever heard of this? If you have, what do you think of? What's your idea on this? Or what's your opinion, or what's your thoughts? The other banker says, the other lender says, well, they clarify, well, I'm not your CPA. I'm not George. I'm not your tax advisor, but some of our bank clients have done this in regards to this area. Some of them have done that. Or have you thought about this? But remember, check with George, check with your tax advisor. They're going to walk away from that meeting with the second banker and go, whoa, there's value added. I emphasize, once again, this is not to make you a licensed CPA and because you don't have it. And this, every once in a while, in my various classes, training the bankers, the lenders, commercial lenders, credit analysts, I will actually have an individual in the class who is a licensed CPA. But I say to them, well, I kind of hint to them, well, you're licensed CPA. And for whatever reason, they migrated from the world of the CPA to become a commercial lender. And I said, well, do you still maintain your license? Oh yeah, I've got it active, in the state of Michigan, the state of Wisconsin, or both, or whatever. And I say to them, well, that's great. But I hint to them, or even say straight out to them, please, you're not, when you deal with Bob and Sue, you're not their tax advisor. Your role is as their lender. So even though they may be a licensed CPA, well, they're representing the bank. They cannot open their mouth and say, well, this is what you need to do, act like as if they're their CPA. No way. No way, because you're in a totally different role or position. The goal sections 2 through 8 added value. Now, what about section 9? We're going to see the changes of the tax code extensively in exhibit 3, our third and final exhibit. Now, the tax code is political. We're going to see this. It's going to be very obvious. We look at this, we're going to bring it all the way to current as of right now. The most recent tax change in America, pardon me, was March 11th of 21. We're going to see this. But as you know, and I'm sure most of you have seen in the press, the US Congress is going back and forth on $1 trillion package, and another for infrastructure and so forth, and another $3.5 trillion package. The ARP plan, American Rescue Plan, we're going to see that's March 11th of 21. That was a $1.9 trillion deal. The tax code is political. It is politically laced. This is great to have this class right now because of what's happening in DC right now, in Washington, DC. I emphasize, though, I am politically neutral. I am politically neutral. I don't take the Democrat, Republican, Independents, nobody's side. Nobody's side. When we get into those tax updates, and by the way, we're not going to wait all the way to that third exhibit towards the end of the session to talk tax updates. As soon as we get into our material in just a half a minute, we're going to talk tax updates. But I am politically neutral. I really am. I just report the facts, which is the law. By the way, who makes the tax code or the law? It's not the IRS. Sometimes people get that wrong, and I even sometimes slip into that habit. It's the US Congress that makes the tax code or law. The IRS is number one, the manager of the process, and number two, the enforcer, if you will. but it's the US Congress. And you will hear me say continuously today, US Congress, US Congress, a little bit IRS, Internal Revenue Service, but mainly US Congress. Pardon me. And then at the very end, to conclude the session, we're going to do a tax quiz. It's a 2-page little summary, and we'll do it as a class. So with that, if you'll move forward to page number 4. Okay, here we go. Page number 4, we've got the personal 1040 tax return. Now, this is the most radical change to the tax code in over about 31 years. It's called the Tax Cuts and Jobs Act. I would highlight that, TCJA. It was put into law or signed into law in December of 17. But when did it become effective? 18 for the most part. So I put that in your notes. It became effective 1/1 of 18. Pardon me, for most provisions, although we're going to see a provision later on today that was delayed by an entire year to 1/1 of 19. The TCJA, the most recently major overhaul of our tax system in America, was back in 1986, and it kicked in January of 87. Pardon me. Major change. But as we're going to see later in our session, with COVID, massive change and changes, including what's happening today in Washington, D.C. As I mentioned, a lot of it's COVID related, a lot of it's not. Look at number 1. In the TCJA, just to kind of summarize some of these, and then we'll get into the forms, standard deduction was nearly doubled. Off to the right of that, number 1, if you please put in your notes, 2017, and then 2018, and then 2021 today. Okay. 2017, 18, and then 2021. Married finally jointly in 17. The standard deduction was $12,700. $12,700. Okay. In 18, because of the TCJA, nearly doubled to $24,000. $24,000. Fast forward to today, 21, the standard deduction, $25,100. $25,100. Whoa. Compared to historical, that's huge. What about a single filer? Single filer standard deduction in 2017, $6,350, $6,350. In 18, nearly doubled to $12,000. $12,000. And in 21, $12,550. $12,550. Okay, now look at number 2. The rule of thumb is you take the higher of the standard deduction or itemized. Itemized, of course, is Schedule A. What's the largest item in Schedule A? The largest item in Schedule A is mortgage interest on the primary residence, on the primary loan, the first on the house, on the home. But the rule of thumb with number 2, you take the higher of the 2. So with the standard deduction doubled, basically, or nearly doubled, we take the higher of the 2, which is now, for a lot of your commercial borrowers, is standard deduction. But look at number 3. Wow, that's a huge benefit, but look at exemptions. If you put in your notes, off to the right of personal exemptions eliminated, in 2017, the exemptions were $4,050 per person. $4,050 per person. In 18, 0. 19, 0. 21, 0. They're gone. So if Bob and Sue, this imaginary couple that own ABC LLC, they have 2 dependent children. In 2017, you take $4,050 times 4, but now it's gone. But of course, the standard deduction was nearly double. Look at the 1040 EZ. Okay, we need a class shout out. Everybody, if you'd unmute your phones, and in the chat, if you'll just type into the chat, please. Have you ever, in the past, have you ever completed a 1040 EZ? Everybody, if you'll unmute yourselves and or in the
Yes.
chat,
Yes.
you'll just
Yes.
type into the
Oh.
chat. Look at, okay, here
No.
comes the chat. Saptarshi, no. Okay. Alexa, yes. Okay. Bob, not for me. Okay. All right. And away we go. Okay. All right. Okay. Now, once again, for those individuals, oh, Jeff's joined us. Okay. Jeff has joined us. Okay. In the chat. Hold on 1 second. I've had a few people join us. Give me 1 second on that. And Justin's joined us. Excellent. Now, Justin and Jeff, if if you can join us, the preferred is through the audio. But if you must, if you can't, that's fine. We'll go ahead and just have you participate with the chat. Okay. Now, once again, please, everyone that's in the audio, let's leave the chat just for the individuals in the chat that don't have the audio. You know, they don't have a speaker, they don't have a mic or whatever, or they're having technical difficulties. So once again, let's allow just the chat people to use the chat. Okay, excellent. So some of you have, some of you haven't. Oh, the 1040 easy use take less than 10 minutes to 10 minutes or so to complete. Well, it was eliminated. Why? Well, because the 1040, starting with the TCJA, was simplified in theory, but it really wasn't. I emphasize it was not simplified. In fact, it was complicated, in my opinion, and in the opinion of most tax preparers. What happened was starting in 2018, the 1040, the back of the 1040 was basically removed and put into schedules 1 through 6. And then in 2019, the 1 through 6 were consolidated into 1, 2, and 3. And that's the same in 20 and anticipated in 21 as well. Now the schedules A through F did not change. It used to be schedules A through F, pardon me, would roll up to the 1040, the old to the old 1040. Well, now schedules A through F roll up to schedules 1, 2, and 3, and they roll up to the 1040. So it's really a different approach, if you will. Okay, now we're going to look at these forms in just a moment. Okay, now under number 6, go down to number 6 if you would. What I'd like you to do, spend just a couple minutes on this, just by way of review. What is the major theme? And you can put these off to the right in that little space. What's the major theme of Schedule A, B, C, D, E, and F? Okay. All right. So take just a moment and write these down if you would. Just without looking at Exhibit 1. I always have people look at the forms. Where are they? So please don't look at Exhibit 1 if you can help it. And if you'd be so kind as you'll go ahead, just to the right there in that space, if you'll go ahead and just briefly, like what's the major gist of Schedule A, Schedule B, C, D, E, and F? Take just a couple of minutes on this, everyone, if you would, please. Okay. Boy, Bob's already got this in. Bob in the chat, he's already got these. Good. Excellent. Pardon me. Good. Take just a moment more. Just take another minute or so, and then we'll go ahead and summarize schedules A through F. Okay, let's go ahead and summarize these. Saptarshi in the chat, would you tell us what is the major theme of Schedule A? We just covered this a minute ago, but what's the major theme of Schedule A? If you'll type that in. And while we wait on that, Dwight, what is the major theme of Schedule B?
That'd be interest and dividends.
Good, excellent. Thank you. Okay, now Saptarshi, Schedule A, itemized deductions, excellent. Largest of which is the mortgage interest. The next two would be large items, typically in Schedule A, is the real estate tax on the home and charitable contributions. Real estate tax and charitable contributions. Excellent. Okay, moving right along. So we've got itemized deductions, Saptarshi said. Dwight, you mentioned Schedule B, interest and dividends. Excellent. What about Schedule C? Mo, what about you? What would Schedule C be?
I think it's unmuted.
Can you hear me, Dave?
Yep, we can hear you.
Schedule C would be your business income.
Okay, what type of business? This is crucial. What type of business?
It's like so.
Yeah, I guess it would be. I tend to see as LLCs, businesses that aren't, your S Corp, C Corps and things like that, but I guess I'm not exactly sure what.
Yeah. The C Corp, or pardon me, the Schedule C, not the C Corp, the Schedule C, sole proprietor or a single member LLC. Sole proprietor or single member LLC. Okay, good. Andrew, what about Schedule D? What's Schedule D?
Capital gains.
Capital gains, capital losses. Excellent. Okay, Charisma, what about you on Schedule E? There are three big ones in Schedule E. Can you name one of them?
Schedule E is rental income from
Excellent.
renting a home.
Good. Rental income. Good. Catherine Lee, what about another one on Schedule E? Can you name?
Royalties.
Royalty income. Excellent. Okay. Excellent. Rental income, royalty income. And let's see, Justin in the chat, can you tell us, can you remember what's the third one in Schedule E? The third one in Schedule E. Okay, if you can put that in the chat. All right. All right, let me ask, Joey, what about you? What would be a third? Do you know the third one on Schedule E?
I don't remember off the top of my head.
No problem. It's the K1 pass-through. The K1 pass-through from the business to the business owner for an LLC partnership and or an S Corp. Excellent. Okay, now from Bob, let's see, Bob in the chat, Schedule F, farm income. Excellent, Bob. Farm income. So we've got farm income. All right. Now moving right along. Look at the first 20% of pass-through income tax free. This is a radical change under Part 7 in the 1040 tax return for the business owner. There's a 20%. This was put into place with the TCJA. There's been discussion of eliminating it. We're going to come back to that later on today. But to get this 20% pass-through income tax free, If you'd add this to your notes under number 7, it must be a small business. Sole proprietor, partnership, LLC, S Corp. This is not intended for large publicly traded C Corps, for example. It's intended, the spirit of number 7 is intended for the small business, if you will. Okay. We'll point this out in just a moment on the tax form. If you turn forward to page number 5, now what I'd like everyone to do, if you'll go ahead, put the main PowerPoint presentation off to the side, pardon me, and then if you'll put exhibit 1 right there in front of you, if you would, please. Let me go ahead, I'm going to stop sharing this and go ahead and share exhibit number 1. So give me just a second on there. There we go. All right. Evan, can you see, pardon me, Evan, can you see exhibit 1 on your screen?
Yes, I can, Dave.
Okay, good. Excellent.
Excuse me.
Okay, excellent there. Okay, thank you. All right. Always like to do that kind of a check, make sure everyone sees it. Okay, now let's go ahead and continue down, if you will. On exhibit 1, if you'll turn with me, just turn down to the 1040. Pretty straightforward information, so forth. Now, look down to line number 1. Remember the emphasis in this upfront, this first of our 4 sections today is cash flow. Just to reiterate and to go into the cash flow issues based off the tax returns. On line number 1, you can see wages, salaries, tips, and so forth. I would highlight or circle the word tips. Put a little note off to the side. You have a restaurant worker, bar, casino, you name it. They get tip income. You can only count the tip income traditionally for cash flow purposes within a bank if the tip income shows up in the W-2. For example, I'm based in Las Vegas, as I mentioned. We have employees that make $30,000 a year in the various casinos. Okay. But they get a W-2 for $60,000. What? They make 30. Their base pay is 30, but their W-2 is 60. Well, wait a minute. Where's the extra 30,000? Well, this is what happens. That extra 30,000 comes from tip income. Based upon their job title, the IRS and the house, which is the casino, about every 5-6 years, they'll negotiate and they'll say, well, based upon these, and this, everyone's got a job classification. Based upon this position, there should be, their tip income should be 30,000. And they literally receive a W-2 for 60,000, even though their base pay is 30. And so you're going like, wow, that's kind of a rip, that's, wait a minute. Well, but don't shed a tear for these people. Why? Well, because in reality, they make another 40,000. They make $100,000 a year. So their base is 30. Their taxable tip income is 30. So they get W-2 for 60. But in reality, they make 100,000. They make an extra 40,000 a year easily. And some of those individuals, that's not an extra 40, it's an extra 100,000 easy that is never taxed. Okay, for example, gentleman that works at Caesar's Palace. I know, he's been there over 50 years. I asked him once, what's your largest tip? I looked at him, I said 50, or I said 5,000. Oh, no, 50,000. 50, what? He goes, oh yeah, some guy won a jackpot once years ago, and he says stumbled out of the casino, Caesar's Palace. He goes, flip me a casino chip. Grabbed it, put it in my pocket. During my break, looked at it, $50,000. How much of that 50 was reported? None of it. was before the BSA, of course. Look at number 2A, 2B. If you'll highlight 2A and 2B, this brings up a major concept in today's session. You have a dollar amount in 2A, tax exempt interest. Bob and Sue own they've invested in a municipal bond issued by the city of Grand Rapids. Okay. For tax purposes, for federal tax purposes, usually that interest is tax exempt, sometimes even for state tax. And then they have taxable income on part B, interest from a bank CD at your bank. Well, wait a minute. If you're George, the CPA, their CPA, if he was analyzing these numbers, would he count 2A? No, it's tax exempt. He'd say, oh no, I'm only going to count B, taxable. But you as the commercial lender, you would count both. Why? Because they physically received both the tax exempt interest and the taxable. So I would put this at the bottom of this page. CPA versus banker, CPA versus banker. When you negotiate with the CPAs of the world, with your clients, CPAs, they will more often think in terms of tax. You will more often think in terms of cash flow. So I put right below CPA tax, right below banker cash flow. Absolutely. Let's move forward. This applies, by the way, to multiple of these concepts today. We've got to ask ourselves, what's the true cash that Bob and Sue received? Go all the way down, go all the way down. You can see, look at line number 12. I'd highlight that standard deduction or itemized. I'd highlight line number 13. That's the QBI, qualified business income deduction, which is that 20%. Absolutely. Let's move forward. The back of the 1040, which is condensed compared to the old form, pardon me, you can see down below the refund, the amount owed, and so forth. They're going to have one or the other, of course. Turn forward, please. Now for the, pardon me, the schedules 1, 2, and 3. This is straight off the IRS website. Schedules 1, 2, and 3. Take a moment, if you would, and read schedules 1, 2, and 3. Just kind of glance at this page just for a moment, if you would, please. Okay. Summarizes these 3 schedules. Remember, when they were first introduced in 2018, there were 6 of them. Now they're consolidated starting in 2019, the very next year, to 3 of them. Take just a moment more on this, if you would, please. Okay, let's move forward. Now let's look at the schedules. I'd highlight schedule 1 in the title. Let's just point out a few cash flow issues. Look at line number 1. We're on schedule 1, line 1. I'd highlight that taxable refund, state tax refund, whether you're in Wisconsin or Michigan, because both states have state tax, income tax. Now, I'd put in your notes next to number 1, please. Approximately 70% of all bank lenders do not add back the state tax refund. Why? Well, because it's from the previous year. Sometimes it's a small amount of dollar amount. It may not recur in the future the same way, and so forth. Approximately 70% plus of all bank lenders do not add back the state tax refund part 1. Jeff in the chat, if you can chime in, does your bank add back the state tax refund? Do you know? You can just say, I don't know in the chat, or yes or no if you know. Definitely. Jeff, if you can type into the chat, please, and just tell us. Do you know? Okay, here it comes. Here's his response. Jeff says, we do not. Excellent. Thank you, Jeff. So you're part of that 70+%. Good. Let's go down to number 3. I'd highlight number 3. We'll see that in a moment. Schedule C, business income. Highlight line number 5, rental, royalty, and the K1 pass through, the big 3. Schedule E, we'll see these in a moment. And then Schedule F. Schedule F, the farm income, I'd highlight as well. Now, we're going to take this to a higher level. Look at other income. Off to the right in that little blank space, I would put NOL, net operating loss. Net operating loss, NOL. Now, we're going to come back to this in our third exhibit, the last exhibit, because this has shifted around because of COVID extensively. The rules related to a net operating loss. Okay, for this section right now, if you would put next to NOL or net operating loss here on line number 8, from a tax standpoint, it is shifted, which we'll cover later. It's the rules related to it. But from a cash flow standpoint, it hasn't really changed. Most commercial lenders, when they see an NOL, and well, let's back up. What is an NOL? Well, an NOL is, let's say ABC LLC, the manufacturing firm, Bob and Sue's company. Let's say 5 years ago, had $1 million operating loss. Well, George, their CPA, says, well, why don't we stretch that loss out over the next 10 years? It's $1 million loss. Take 100,000 a year NOL. It's going to knock down their tax bill significantly. Of course, it took $1 million loss to do it. But George is able to structure it this way legitimately. So for the next 10 years, every year there's an NOL on line number 8, 100,000 loss carried forward. Boy, when it's mathematically added into their tax, wow. Huge benefit to them. Now that's from a tax standpoint. The rules of it have changed, which we're going to save because it gets a little complicated. We'll save till later on. Well, but what about from a cash flow standpoint? From a cash flow standpoint, I'd put this in your notes. Most commercial lenders, it's not a positive nor a negative. It's a neither. Why? Because the $1 million loss took place when? 5 years ago. And it's going to be stretched out over a 10-year period. And they've got another 5 years to go, and they're taking 100,000 each year, of course, just using the simple model or simple example. But from a cash flow standpoint, most lenders, and I agree with this, it's not a positive nor a negative to our cash flow modeling. Questions on that? Catherine Walker, any questions on that one?
Nope, not on that one.
Okay, great. All right, moving right along. Go down to number 10. I'd highlight educator expense, $250. Congress years ago said K through 12 teachers, they spend $1,000 to $2,000 a year in their classroom. They can write off up to $250. By the way, with COVID, with the CARES Act, that's been expanded so that if the teacher uses any of their personal money and never gets reimbursed for like a mask or something, that can be included within the $250, but it's only still $250. Go all the way down, look at IRA deduction, number 19 down below. We'll see that in a moment. Later on, actually, I should say in Exhibit 3. Moving right along, let's turn forward. Schedule 2, if you'll highlight Schedule 2 and the additional taxes, line number 4, I'd highlight the most common line item you'll see in this particular schedule. The self-employment tax for Bob and Sue. Moving right along, Schedule 3, I'd highlight Schedule 3 in the title. Look at line number 2, I'd highlight child credit. This is for dependent care and so forth. With COVID, this shifted around significantly as parents had to go home to work. Well, in some situations, the dependent care expenses dropped. In other cases, it increased. Kind of interesting. Moving right along. Let's turn forward now to Schedule A. And once again, some of this is just a quick review, but we're emphasizing once again primarily cash flow in both the personal and what we'll see in a moment on the business tax forms. Schedule A, of course, we really don't use Schedule A in our cash flow modeling. It's kind of, in my opinion, if you see it, remember, if you see it, they've got itemized deductions if it's married, finally, jointly in this year in 21 above 25,100, or single filer 12,550. So a lot of you, once again, you don't even see this. Just a thought. Moving right along, because your clients use the higher of the two, which is oftentimes today the standard deduction. Schedule B. All right, Schedule B, just a couple of thoughts. If you'll highlight this and highlight the title. Pardon me, look at the middle of Schedule B between 4 and 5. You see between 4 and 5? You only need to complete this form, or the tax preparer, George, the CPA, only needs to prepare this form if the interest or the dividends, what have you, are over $1,500. Used to be only $500, then it went to $1,000 over the last several years. Now it's $1,500. Okay, now 3 forms of interest. This is huge. We're going to dissect this deep. If you would put this in your notes in this blank space up above, 3 forms of interest, at the very top of that, if you put a number 1, about halfway down to number 2, and towards the bottom, number 3. 3 forms of interest you'll see on this form. Okay, and it does, and depending on the interest, the type of interest can change how you interpret or should interpret, pardon me, the cash flow. Section number 1, if you put in your notes, bank interest. Well, bank interest is very straightforward. I mean, you probably would count it in the cash flow. Go to number 2. Go to number 2, a note receivable. A note receivable. Bob and Sue get a call late one night. Sue's grandma has passed. Sue's grandma willed her home. Okay, where's the home? Gladstone, Michigan, in the UP. Free and clear. Bob and Sue say, wow, we're in Grand Rapids. We're not going to drive all the way up there, take care of a rental. We're not going to rent it. Let's just sell it off. Someone approaches them to buy it, calls the phone number for sell by owner. They say, well, I went through a divorce a few years ago. My credit's just slaughtered, but it's shot. But boy, I'll give you a good deposit or good down payment, not deposit, but down payment. If you carry the paper, oh yeah, we'll do it. Well, note receivable interest. Go to number 3 down below. This is called the pass-through. The third type of interest, it's called a pass-through. Sometimes you'll see the name of an LLC. That's another form of interest that you'll see. Okay, now, do you or do you not include any of these interest items in your cash flow? Well, at the top of this page, if you would put in your notes a model, it's a 3-step model that's going to help us determine yes or no, do we include these in our cash flow? Step number one at the very top of the 3-step model, recurring, the word recurring. Step number 2, significant dollar amount, significant dollar amount. And number 3, verification, verification. Step number 1, does this event happen every year? Yes or no? Does it happen every year? Yes or no? Number 2, is it a significant dollar amount? If that interest from the bank CD is $300, we're not going to count that in the cash flow. But if it's 5,000 or even, even 1,000 or 5,000 or 10,000, oh, absolutely. But $300 or $50, probably not. Is it recurring? Number 1. Is it significant? And number 3, can you verify it with a bank statement, a brokerage statement, something of that nature? Absolutely. Okay. What about number 2? This is the note receivable. Well, we go back to the 3 steps on the very top of the page. Is it recurring? Well, what if it's brand new? Well, no, we're not going to count it. It's not a seasoned note. But what if Bob and Sue did this, or Sue did this transaction? She sold grandma's house and carried the paper 3-4 years ago. Well, it's 3 or 4 years. There's a track record. It's recurring. Okay, it meets the first standard. Number 2, is it significant? Oh yeah, the payment's like $1,300 a month in principal and interest. The owner of the house handles the taxes and insurance on their own. Sue's not set up to have an impound account for them. So yeah, absolutely. It's significant. It could be combined, $10,000, $12,000, whatever. Number 3, can you verify it? Absolutely. Bob and Sue set up a special account at your bank, deposit account, where those payments are deposited into. Absolutely. Step number 3 down below, the pass-through. Now, what is this? Bob and Sue have ownership in an LLC. They receive interest income through the LLC. Well, they have to pick it up as taxable, but they never physically receive the cash. That's why that's why a lot of times on this form, right in this little section, pardon me, you'll see the words pass through. And there's oftentimes the name of the LLC. Well, they're taxed on it, but they physically never receive the cash. So under the 3rd version, I put a little note, don't count this in the cash flow. No way. Why? They never receive the cash. Absolutely. Questions on this? Joey Hallman, any questions? Any
Nope,
questions?
no questions over here.
Got it. Excellent. Moving right along, let's go forward to Schedule C. Schedule C, sole proprietor or single member LLC. Okay. Just quickly to review the cash flow model. If you'll highlight line number 31, net income, net loss, add back line number 16, A and B, the interest, add back line number 13, the depreciation. Then if there's any amortization, it would be on the 2nd page or the back of the Schedule C under Part V or 5. I put the word amortization with the question mark at the bottom here. Okay. And then lastly, go back to the front of the Schedule C, add back line number 12, depletion. This is our basic EBITDA formula. Net income, net loss, line 31, plus line number 16, A and B, interest, plus line number 13, depreciation, pardon me, plus at the back or the 2nd page under Part V, amortization, and then lastly, add back line number 12, depletion. We've got the formula. Now we're going to come back to in our business section the wisdom of not filing for an LLC under Schedule C. Just hold that thought. In other words, get it out of the single member LLC, which you're forced to file as a Schedule C, to where there's multiple members. We'll come back to that in a moment. Strategy, we get into our strategy section. Moving right along, last is Schedule D, cap gains, cap losses. Now, short-term, long-term, short-term part 1, part 2, about halfway down, long-term. Short-term, a year or less, long-term, more than a year. Let's read the cash flow, of course. Under box E, in that little blank box, if you put 5,000, Bob and Sue buy a stock for $5,000 this year, 21. This is a 20 tax term, but let's say it's 21. To the left under box D in that blank spot, if you put 20,000, they sell the stock for $20,000. Over to the far right under the H column, pardon me, the gain is 15,000. Okay, they buy it for 5, sell it for 20, it's 15 gain. That's pretty straightforward. What will George say this activity is? 15,000. Okay, from the CPA tax perspective, oh, you're going to get taxed on 15,000. A percentage of the 15,000. But what about you as the commercial lender? Graham, you're the commercial lender. You may agree, you may not agree. Would you agree with George or not? Would you say, oh yeah, it's 15,000 cash flow? Remember, the hint is it's less than a year. It's within the year. Graham,
Yes.
what would you say? Pardon me?
Yes, I believe you would.
Yeah, and you're right. As a commercial lender, you'd say, oh, it's 15,000 cash flow. Absolutely. But let's look down below. Look at line number 6. Do you see line number 6? If you put in your notes 20,000, and line number 7 is now a negative 5,000. Now, what is line number 6? Short-term capital loss carryover. Now, what is that? Well, Bob and Sue had a $20,000 loss about 2 years ago by selling some stock and what have you. Well, they didn't use it. They didn't need it that year. George says, let's just save this up. Let's just save that up. And we will use it in a future year. Well, this year, they're going to get taxed on 15,000. George says to him, hey, remember that capital loss carryover from a couple of years ago? Why don't we just pop it in here? And now line number 7 is a negative 5. George is going to say now this activity is a negative 5,000. Why? Because George emphasizes tax. What would you argue that this activity is? Jack, what would you say? George is going to say, well, this is a negative 5,000 tax from a tax standpoint. But what would you say, Jack, from a commercial lender's cash flow perspective? What is the dollar amount?
I mean, I guess I would still say the 15,000.
You're
but
right on.
I'm not sure.
You're right on. You got it. It's still 15,000. Remember, George, the CPA, focuses on tax. We focus on what? Cash flow. You're right on. You got it, Jack. It's still 15,000. Okay, let's move forward. Let's move forward to long-term capital gain or losses down below. More than a year. Everybody, if you put 5,000 in box E, the cost. Okay. Proceeds to the left. This is under part 2. To the left, 20,000. They buy the stock, but when did they buy the stock? 7 years ago. They bought it for 5, they sold it for 20. The gain or loss, the gain over to the far right is 15,000. Okay. How much would George, the CPA, say this activity is? Mickey, let's ask you, what do you think George would say? He's going to say what dollar amount? Because remember, he fixates on the tax.
Yeah, I think George would. Well,
Remember?
yeah, I would think 15. I don't know the.
Yeah, no, that's what it is. George would
Okay.
say it's 15,000 from a tax perspective. But what would we say from a commercial lending cash flow perspective? It's 20,000. Whoa, 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 whoa. Why 20? Because that's how much cash Bob and Sue received. You're saying, well, what about the 5? That was done 7 years ago. We could care less. Now, George will fixate on, oh no, it cost him 5. They sold it for 20. I'm going to, in my mind, it's 15,000. Well, yeah, from a tax standpoint. But as commercial underwriters, we look at the tax, we understand his side of the equation or his argument. But from our perspective, it is 20,000 on the table. Does that make sense, Mickey?
Yes, it does.
You bet. Great.
Sorry about
Oh,
that, David. We're still
problem.
experiencing some technical issues. That's
Oh,
why I
sorry.
didn't know we disconnected. We're back.
Okay, thank you. Thank you for that. Okay. In fact, if you do, my recommendation is you can go out of the class and then come back in like you did probably. Good. Okay. Now, any questions on either short-term capital gains, losses, and or long-term capital gains or losses? Dylan, any questions on Schedule D?
I have no questions right now.
Okay, thank you. Heather, how about you? Any questions on this?
I'm good.
Good, excellent. Moving
Hey,
right
David,
along.
I have
Go
a
ahead.
question.
And who's,
This
wait,
is Andrew, sorry.
Andrew, go ahead, no problem.
Yep. So our bank gives them no credit towards capital gains. In some situations, we may give them credit towards it if there's a significant amount that causes their federal income tax to like skyrocket.
Mhm.
However, typically we don't give them any consideration from a cash flow perspective. So could you just, because
Well, okay.
we're utilizing this to kind of go back and see if there are
Yeah.
changes that maybe we should make. So
Well,
could you just high level again, just the
Yes,
short
okay.
term and long term? Since
Okay.
the short term you indicated from cash flow, we would utilize the gain. However, with long term, we would utilize proceeds, just a high level
Yes.
again.
Yes, now this is where we would look at it now. Let me back up. We still use those 3 same rules of thumb on multiple of these models, not just Schedule B, not just, we could use it on Schedule B, C, D, all of them. So Andrew, we would still go back to our 3 general rules of thumb. Number 1, is it a recurring event? Number 2, is it significant? And number 3, can you verify it? So now there are some credit administrators in our industry, some banks, it doesn't matter if it is recurring, if it is significant and we can verify it, if it is under Schedule D capital gains, capital losses, some banks exclude it. Doesn't matter. Some credit administrators feel, no, we don't think it's consistent enough. It's recurring. Even if it's recurring, we're not going to do it. We're not going to include it in the cash flow modeling. Other credit administrators say, oh, absolutely, if it meets the 3 standards, if it's recurring, if it's significant, and we can verify it. Does that make sense, Andrew?
Yes, sir.
You bet. Now, back to your issue of the large dollar amount. I've seen that. And most banks, though, even if it's a large dollar amount, if it's not recurring, boom, it's done. We don't include it at all. Unless you're my old boss at Bank of America. If he liked the client and he wanted to do the deal because he was our team leader, but he also managed his own portfolio, did underwriting the whole bit. He would bend over backwards in Schedule D. For example, if you look at this, he would say, if it was, for example, Let's say they had a capital, and I saw this live. I couldn't believe it did this. 3 years of tax returns. Only 1 year even had capital gains, and it was 300,000. It was a one-time deal. It was not recurring. It was significant. Could he verify it? Oh, absolutely. It met 2 of the 3 standards, but not the first one, which is the big one. Is it recurring? My boss took that 300,000 for the 1 year, and with a 3-year tax, with the 3-year cash flow model using the 3 years of tax returns, he took the 300,000 and averaged it and put 100,000 in each year. Now, how did I know this? Because he used to come in my office all the time to have me look at his numbers, check his cash flow numbers, and he would give me the tax returns, and I'd look through them and look at his numbers. And I said, well wait a minute, this is non-recurring. Oh, no. I talked to the client, and it was Dr. Jones. I talked to Dr. Jones, and she told me that she's going to have more capital gains, income in the future. And so that's going to be recurring. The very next week, this is true, this happened. The very next week, same team leader rocks in my office. Hey, can you check my numbers? Oh yeah. And it was a regular weekly event. And I looked through the numbers, and there was a different customer, and it was like 200,000 or 300,000, almost verbatim the same scenario. And under capital gains in our format for our cash flow model, he just had blanks. I said, well, wait a minute. I went into him. I said, wait a minute. You got a $200,000 or $300,000 capital gain, but you didn't average it. Oh no, he looked at me and he was real serious. He goes, well, we don't do that. I said, what do you mean? He goes, well, it was non-recurring. And I said, well, but you did it with Dr. Jones's deal last week. Oh no, you must be mistaken, David. You must be mistaken. I said, yeah, I must have been mistaken. I walked out of his office, just in my mind, just cracking up like, yeah, right. He liked Dr. Jones. Why? Dr. Jones had a membership in a golf course community. My boss was a golfer. Nothing wrong with being a golfer. Nothing wrong with going to the golf course community where your client has a membership. The other customer, he didn't really like that guy. Not just because he wasn't a golfer, but personalities rubbed each other wrong. But Dr. Jones, boy, he pushed, I want this deal approved. This boss of mine was noted as a very, and I say this tongue in cheek, creative cash flow underwriter. He would interpret and this was just one issue or one scenario or situation I saw. Oh, working with them for years, numerous, by hook or by crook. If he wanted to do that deal, he made those numbers, make sure those numbers were in place to get that deal approved. Matthew, comments, questions on that? Matthew, do not mention names. Have you ever worked with a creative cash flow underwriter in your career? Matthew.
Yeah, no questions on that. I mean, it's tempting at times, but otherwise, no.
But have you ever known of someone so far in your career, Matthew, that you kind of wondered, boy, they're quote unquote, I say that tongue in cheek, they're a real creative cash flow underwriter. Have you seen that?
I would say no.
Okay, just wait, you will. Continue in your career, you will. James, have you ever seen that so far in your underwriting? Have you ever worked with someone that, boy, you got the impression, wow, where do they get their numbers from? James,
yeah, a couple of times. Not necessarily on the capital gains. I mean, I've seen that before too, but I remember one time there was a guy giving me a lot of grief about underwriting where we included personal expenses of $15,000 because this individual was still living with his parents at the time. And he said, he's living with his parents. How does he have 15,000? But, so we went back and forth on that. But yeah, I've had a couple experiences.
Okay, great. Thank you for that. Some of you have, some of you haven't. Generally speaking, it's just a matter of time. as you continue in your career as a credit analyst, as a loan officer, so forth, you'll come up, you'll work with people. They'll even be your boss. Like in my case, it was our team leader, my boss, who was the creative underwriter. You think, oh, it's just some analyst, some credit analyst, or this rogue loan officer. Oh no, sometimes I've even seen credit administrators that will, quote unquote, modify the numbers because, they want to do the deal, or maybe even senior management above them have made, basically said, this deal's going to get approved. Oh, okay. Maybe the chair of the board of the bank, of your community bank, or the president of community bank comes to the chief credit officer and says, or chief credit administrator, this one we're going to do, and the numbers aren't there, but all of a sudden they are. That does happen. That does happen. That's the real world that we live in, the human side of cash flow analysis, if you will. Let's move forward. Let's move forward to Schedule E, and we're going to stop right there. And let's take our first break of the morning. Let's take a 5-minute break, and we'll come on back. Excellent, excellent participation. Questions, comments, excellent. Talk to you in 5 minutes, everyone.
Plan. Get started by visiting one of CSB's 9 locations today. Watch your savings grow. Bank with Central Savings Bank.
Central Savings Bank. Ask what we can do for you.
You lost your debit card and now you need it replaced? Let's face it, nobody likes to wait days or even weeks on a debit card replacement. Lucky for you, Central Savings Bank has a new instant issue debit card. Walk into our main branch office. We'll print you a card on the spot, ending the wait for it to come in the mail. You'll have it in hand the same day. Bank on the service you deserve this holiday season with Central Savings Bank. Member FDIC, Equal Housing Lender.
At Central Savings Bank, we want you to have a financially stable future. With an individual retirement account, or IRA, your future can start and stay here locally. Planning your future is important to us, so let us help you here at Central Savings Bank and watch your savings grow over time. For more information on opening an IRA, call, click, or stop by any Central Savings Bank, where we are providing you a secure and safe future. Member FDIC, Equal Housing Lender.
In today's fast-paced world, convenience is key. Central Savings Bank knows this and keeps you up to date with all the latest banking technology. Pay securely and conveniently with Mobile Wallet. Manage all your banking needs with internet banking. Central Savings Bank has been in business since 1902, and there's a reason why. No hassle checking and savings accounts. Apply easily for a home loan or home equity loan. See for yourself why CSB is Chippewa County's leading mortgage processor. Not a fan of waiting? No problem. Central cards. Switch today and experience old-fashioned customer service along with the latest banking trends. CSB's experts can also help you with the savings
Welcome back, everyone. We'll take just a moment and get started. Okay, here we go. Alonzo, can you do our sound check for us, please? Are you back with us? Wait just a second. Okay, wait just a second
Can you
for
hear me
everyone.
now?
Oh, yeah, I can hear you now. Alonzo, good.
Couldn't get me unmuted.
Oh, no problem. Good. Thank you for doing the sound check. Let's go ahead. Before we continue in Schedule E, are there any questions on schedules A, B, C, or D? A, B, C, all the way A to D, A, B, C, D. Any questions before we continue? Okay. All right. Schedule E, rental income. The formula, of course, is if you'd highlight line number 3, rents received, minus line number 20, total expenses, add back line number 18, depreciation, and add back line number 12, mortgage interest. Now that's up above. That's the inflow. The outflow, of course, would be the monthly payments times 12, annual, of course. So it's line number 3, pardon me, rents received on the rental, minus line number 20, total expenses, add back line number 18, depreciation, add back line number 12, mortgage interest. So let's say Bob and Sue own a rental house in Grand Rapids. That one they can manage. That's why they sold grandma's house up in Gladstone in the UP. They said, no, this is just too far, if you will. Now, any questions on the cash flow model for the rental property? Alexa, if you'll type into the chat, any questions, if you would. Okay.
David, we would also add in 19 only if it included amortization, right?
Oh, yes. Good point. If you'll add that to your notes, line number 19, if there was amortization, you could definitely, or even depletion, and although that would be unusual, but there could be some amortization from a loan or what have you. Good point. Good point. Line number 19. Some lenders will also add back line number 13, other interest, if there, because sometimes it may be reported differently, not just the mortgage interest. Maybe there's a first and a second on the rental property. Fine, as long as the debt service is matched up down below. Good point. Yes. Okay. No questions? Good. Alexa has no questions. Thank you, Alexa. Now let's move forward, if you would. If you'll turn with me now to Schedule F, farm income. Okay, if you'll highlight Schedule F and the farm income. And now what I'd like to do is let's do a quick class shout out. A quick class shout out. Everybody unmute yourself. Everybody in the chat respond. Does your bank do any ag lending? Any ag lending?
Yes.
If you'll just
Yes.
shout out.
Yes.
No.
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 Okay.
Yes.
Yes. Boy, we've got it kind of split. We got it split. Okay. From the chat, Alexa says yes. Bob says no. Okay. So that's split. That's kind of interesting. About 50-50, pretty close. Maybe a little more no's than yeses, but pretty close. All right. Now, Schedule F, farm income. Let's go ahead and do the cash flow model. It's similar to a Schedule C, as you can see the format. The formula would be, the cash flow formula is line number 34, net income or net loss from the farm. Add back line number 21, A and B, the interest. Pardon me. Add back line number 14, depreciation. And then under 32A, over in the middle there, I would add the word amortization question mark. And under 32B, depletion question mark. Kind of like was just mentioned. Andrew, you just mentioned back on the previous, you said, well, on the rental, If there's amortization, you add it back in, same idea. So once again, line number 34, net income, net loss, add back 21A and B interest, add back line 14 depreciation, add back 32A depletion, question mark, 32B amortiz, or pardon me, 32A amortization, 32B depletion, question mark, question mark. If they're there, we add them back in. Farm income. Any other comments on Schedule F for farm income? From those of you that may even be ag lenders, a few of you, about roughly a little less than half the class, you do ag lending, but if you are an ag lender, if there are any comments that you can give us to benefit Schedule F, any comments on this? Okay. All right. Let's move forward. Let's go ahead. If you'll go ahead and take the Exhibit 1 and put it to the side, and then if you'll go back to the main PowerPoint. So give me just a moment like this. Give me just a second. Okay. Okay, wait, there's a question back on, hold on, there's a question before we leave the personal tax forms. There's a question back on Schedule E. Bob in the chat, Bob, go ahead. If you'll just type in what's your question and we'll address it. While you do that, let's go back just one form to Schedule E. Okay, so I'm going to turn back to Schedule E. And Bob, okay, here's the question under the chat. Can line number 9 ever be added back to the cash flow? Line number 9. Whew. Maybe. This, some lenders, and Bob, that's a good question. Some lenders may add back line number 9, the insurance, because if the payments down below are not just principal and interest, but they're PITI, principal, interest, taxes, and insurance, the answer, Bob, is yes. A lot of lenders don't do it. A lot of lenders, especially commercial lenders, more of a consumer lender may do this where they're, on the rental property, but a lot of commercial lenders simply just use the format we covered. Line number 3, minus 20, add back line number 18, depreciation, add back line number 12, mortgage interest. But it could be. There's nothing wrong with that, because when you ask Bob and Sue, well, what are the payments on the rental property? Oh, well, they're $1,250 a month. Well, chances are it's PITI, it's the impounded amount, principal, interest, taxes, and insurance. So if that's the case, you add back the insurance up above, it just clears it out down below. Good point. Good point. Okay. Yes. And this is exactly what Bob says. He goes, he'll do that if the payment is PITI, which usually it is. But I will say this, Bob, a lot of lenders just, especially commercial lenders now, they just use the basic form and then they just put the whole payment down below. But Bob, you're more accurate the way you're doing it. Now, once again, I mentioned earlier when we covered this, line number 13, other interest could be added back in, and there could be other items potentially on each of these could be justifiably added back in, depending on the actual circumstance as well. You bet. Good point. Now let's go ahead. Let's put this exhibit 1 to the side, and let me go back and let's go back to the main PowerPoint. So give me just a second on the main PowerPoint, if you would. Okay, we're back in the main PowerPoint, page number 5. If you'll turn with me to page number 6. Now we're going to shift, pardon me, to the business side. The LLC we're going to see in a moment is the 1065. The S Corp is the 1120S. The C Corp is the 1120. We'll look at schedules M1 and M2. We're going to talk extensively on depreciation. Why? Well, because when we get to our tax strategy area, our second major area, the depreciation becomes a huge strategy. there are 3 forms of depreciation we're going to look at on Form 4562. Then we'll also look at the K1s, both for the LLC partnership and the S Corp, to make sure we're reading the correct cash flow coming off those K1s, or from basically from the business to Bob, the business to Sue, and so forth. Moving right along. Now let's go, if you'd be so kind as to put the main PowerPoint off to the side and put Exhibit 2, just grab Exhibit 2 and let me go ahead and share Exhibit number 2. Okay, now give me just a second on this one. I need to reach out and grab that. All right. Give me just a second. Pop that one up. Okay, there we go. All right, Jordan, can you see Exhibit 2 on your screen?
Yeah, I can see it.
Excellent. Thank you for doing the check for us. Now let's go into the business forms. We're going to start with the 1065 partnership or LLC first. Pardon me. Then we're going to go into the 1120S for the S Corp, and then lastly, the 1120 for the C Corp. Okay. Now, if you'll turn with me forward, we'll start with the partnership, the 1065 LLC. Now, just to highlight the basic cash flow, in the middle of this page, if you would please highlight line number 22, business income, net loss. Okay. Add back line number 15, interest. Add back line number 16A, depreciation. And then if there is any amortization, it would be found on line number 20. But if you'd put off to the right, C statement, amortization question mark, it would be in the back of the return. It would be in the back, kind of like on Schedule C is on the next page, or the back of Schedule C under Part V or 5. Similar, we have to go to the back of the return to see if there's any amortization. And then lastly, add back line number 17, depletion. Let me say that again. Line number 22, net income, net loss. Add back line number 15, interest. Add back line number 16A, and I'd be highlighting and or you can put the codes, with your pen off to the side or at the bottom, or both. Add back 16A, depreciation. Add back line number 20, amortization, in the back of the return. And then lastly, if it exists, line number 17, depletion. If you'll take your pen, you see line number 14 shows taxes and licenses. I would slash through the word taxes to remind us, this is not income tax. So we don't add it back into the EBITDA formula. The EBITDA formula, EBITDA, the T only applies for a C Corp, which we'll see in a moment. An LLC, partnership LLC, or an S Corp, those are pass-through entities for tax purposes. The profit or loss passes from the business to the business owners, taxed once at the business owner level. This is tax, this underlined 14 would be like property tax on equipment or whatever other tax the company's paying, but we don't add that back into the cash flow. Let's move forward. Turn forward in this 1065 about 5 pages or so. About 5 pages, if you just turn forward with me to the balance sheet. So you should be on the balance sheet, and at the very bottom, you'll see Schedule M1. Okay, so about five pages in, you see the balance sheet. Then at the bottom of the balance sheet, we're going to cover Schedules M1 and M2. M1 is simply a reconciliation of the income of the company per its books or financial statement versus the tax return. That's all it is. Now, to keep your commercial borrower honest, I would highlight line number 1 in Schedule M1. Do you see where it says net income or loss per books? I'd highlight that and put a little note. You have a tax return for year end 20, this tax return, year end 2020. Okay. You match up this 2020 tax return to the company prepared financial statement for the same period, year end 20, 12/31 of 20. Those numbers should match or be very close, because they're telling the IRS, oh, our net income per our books is, say for example, 300,000 over in the box. Well, what if the company prepared financial statement is 400,000? Wow. Something's wrong. Absolutely. Telling the IRS one thing, trying to show us something different. Well, I had a client when I was on your side of the table. This actually happened to me. He gave me his financial package. He was applying for like a $300,000 equipment loan for his business. And he was an existing customer of the bank. And he had everything in the financial package, personal tax returns, everything, but he did not have his business tax returns. He looked at me and he says, we met, we reviewed everything. I said, wait a minute, we're missing your business tax returns. He looked at me and goes, oh, you don't need those. I would add this somewhere in your notes for today's session. If soon as a client starts to dictate to you, oh, you don't need those, I'm going to say it straight out. That is when you need those. That is absolutely when you need those, need the information. So I said, well, I cannot proceed with even looking at this deal until I get those tax returns. He goes, oh, okay. And then a week later, he called me, he goes, oh, have you got the deal approved? I said, no, I haven't even started on it. What? He starts to quote unquote freak out on the phone, starts yelling. And I said, oh, no, remember, we need those tax returns. Oh, no, you don't need them. Oh, yeah, we do. Okay. 3 days later, he calls me back again. Okay, what's the status? I said, I haven't touched it. What? I said, remember, I did this. Oh, okay. That afternoon, here comes his runner. They bring me the tax return. I open the business tax return to Schedule M1 line 1. Now, I already had the company prepared financial statement for the same period, and it was 400,000 net income. Sure enough, this says 300,000. I knew he was playing games. Now, I want to emphasize, we as commercial lenders, you are not the agent. You are not the agent of the IRS. You're not. But that doesn't mean that we don't want our customers to be in compliance with the IRS. Absolutely, we want them to. Why? Well, we don't want them to be audited. We don't want them to go sideways with the IRS. We don't want the IRS to come in and charge them penalties, interest, all these other issues that can take place. Lien their commercial building that we financed. Wow. Because they haven't paid their taxes. No. But at the same time, the IRS, we are not. Your bank is not the agent of the IRS. Dwight, does that make sense what I just said? Does that make sense? Don't know if I know you're having some technical difficulty. Andrew, does that make sense what I'm saying?
Yes, sir.
You bet. Your bank, you are not the agent of the IRS. You're not an extension of the IRS. Oh, you're a federally insured institution. But that has nothing to do with the IRS. It's a whole different agency, FDIC. Absolutely. Different federal agency. Totally different world. In fact, I'm going to just say this without speaking out of school. In some ways, the IRS is can be, not always, but can be your bank's bitter enemy. What? The IRS? How can they be your bank's bitter enemy? Well, your bank is foreclosing on a building. And all of a sudden, the IRS slaps a lien on that building because they haven't been paid as well. Now, all of a sudden, you have another creditor vying for the same asset, vying for the same exact asset. So all of a sudden, the IRS becomes an adversary to your bank. Charisma, does that make sense what I'm saying?
Yes.
Yeah. No, I'm not saying we try to pick a fight with the IRS. No, your bank, no way. But they're not your friend. And I'm telling you, they look out for one party. It's themselves. Moving right along. Schedule M2. By the way, back on that $300,000 equipment loan, we declined the deal. Now, how do we justify it? Well, we didn't justify it. We did not accuse this borrower. I didn't accuse him of being a tax cheat or playing games with the IRS. I didn't. But I went to my boss. I showed her, explained it. She goes, oh, yeah, I agree. So we used legitimate other reasons to decline the deal. Their liquidity was a little weak and some of the other financial factors. But the real reason, which we never told the client, was we didn't trust him. And we were leery or concerned with his interaction with the IRS, quite frankly. You know, if they got wind of this and what have you, and came in, audited him, wow, that could impede his company's ability to do what? Repay this loan or the proposed loan. Look at Schedule M2. Reconciliation, all it is a reconciliation of the partner's account, the partner's capital account. That's all it is. You can see the beginning of the year. Is there any contributions, net income, net loss, all the way over to line number 6 in the bottom right, any distributions and so forth. Let's move forward. Now for 4562. If you'll highlight that, I'd highlight each of these forms. And before I forget, I would encourage each of you to please keep this material in a binder after today's session. You can always reference back. If you've highlighted the pages, it's going to be much easier to reference back to your notes. Just a thought. Now, 4562, there are 3 forms of depreciation. And I emphasize this lays the foundation for our tax strategy section we'll cover later on in just a few minutes. We'll start into. Now, let's go to the very bottom. We'll start with the most common depreciation makers, part 3 at the bottom, left-hand side of the page. If you please highlight that. Makers stands for, or MACRS, under part 3, stands for Modified Accelerated Cost Recovery System. Modified Accelerated Cost Recovery System. If you look down on the bottom left, you can see 19A through I. 3-year property depreciation. Off to the right, I put a computer. 5-year, a vehicle or a piece of equipment. Okay. 7 to 25 years. These are just examples. Pardon me, 7 to 25 years, depending on the size, an airplane or aircraft. Smaller planes, 7 or 10 years. Large, commercial jet, what have you, 25 years. What about, in fact, I banked, when I was on your side of the table, I banked a small airline, and they're still in existence. They take tourists from Las Vegas and fly them over the Grand Canyon. Seriously, that's their main business. Well, they were on a 20-year depreciation because these were smaller planes. These are not corporate jets. These are smaller planes. and they got a new CFO, you know, a new Jane that worked with the CPA, and they were able to decrease from 20 to 15 years to accelerate the depreciation on the aircraft, which was a huge tax benefit. Let's go to H, residential. There's the rental property that Bob and Sue own in Grand Rapids area. If you go over to the middle, 27.5 years, I'd highlight it, is the time frame for the depreciation of a rental property. Then look under I. This is categorized as non-residential real property. Okay, non-residential. I put in your notes. This is commercial property, but this could also, for the ag lenders in our class today, this could include some of those buildings on the farm that traditionally you wouldn't think of as a commercial building, like an office or an office warehouse. That's why it's kind of a catch-all. It's a non-residential real property. 39 years over in the middle, if you'd highlight. Now we're going to see in just a few minutes a legitimate strategy that will halve the 39 years, meaning bring it down to 20 or 21 years, which means the depreciation doesn't go away, but the depreciation is doubled essentially, or accelerated. Huge tax benefit strategy. Okay, now that's from the tax standpoint. From the cash flow perspective, essentially all commercial lenders all over America will add back makers to cash flow. That's our traditional add back, the depreciation. But let's go up above to number 2. I want to emphasize. Number 2 is under Part 1, Section 179. Now, for those that were with us yesterday, I mentioned this briefly. We covered this a little bit, but today we can actually look, we're looking at the forms. Over to the right, the top right, you see 1, 2, 3, 4, and 5. And box number 1, if you would please put $1,050,000. $1,050,000. Pardon me. In box 2, if you'd put 750,000, 750. In box 3 on the top right, if you would put 2.6 million plus, it's a little over 2.6 million. Okay. Now, what's this Section 179? This is part of the tax code that allows Bob and Sue, the manufacturer, to buy a piece of equipment and potentially write it off in 1 year, through depreciation, depreciate it out in 1 year, the entire asset. What is box 1, the 1,050,000? If you'd have this to your notes, please, the 1,050,000 is the maximum in the year 21 that can be written off in one shot. Drop down to box number, so the number 1 is the maximum that can be written off this year. For whatever it's worth in 2020, these tax forms, which are the most current. We can't have more current tax forms than 2020. Why? Well, because we're not going to see these until the first of next year in the new tax season in 22 for 21. So, but let's say in 20, for whatever it's worth, is 1,040,000. But as of right now, this year, 1,050,000. What about box 3, the 2.6 million plus? This means this is part of the code that says, and you can see it's called the threshold cost. That means as long as the company does not purchase more than 2.6 million plus in equipment, they can write off 1,050,000. Okay. What's the 750 on line 2? That's the make-believe dollar amount of the equipment that Bob and Sue purchased. That's the make-believe dollar amount that they purchased. So the 750 is underneath the 1,050,000, of course. So they can write it all off, and it's of course below the 2.6 million. So they don't even breach that. They're below both of those hurdles, if you will. In one shot, they can write it off. Okay, I'm going to ask Catherine Lee, does your bank add back Section 179 depreciation into your traditional EBITDA cash flow for the business?
Yeah, I've seen it added back.
You've seen it added back. Good. Justin in the chat, and Bob in the chat, and Jeff in the chat, if you can chime in, yes or no, do your banks add back Section 179 into the cash flow? Some banks do, some banks don't. You can just chime in if you would, if you'll type into the chat. Okay. While we wait on that, on those responses, Joey Merlino, does your bank add back Section 179?
Yes, we do.
Okay, you do. Excellent. Okay, now from the chat. All right. Let's see. Jeff does. Bob does. Both their banks do. Okay, now if you will please, thank you for those responses, by the way, everyone. But if you will add this right next to Section 179, or maybe right above that at the top of this page, approximately 60% of all commercial lenders do not add back Section 179. 60%, 60. 40% do nationwide as of right now. 60% do not. Well, why don't they? Well, they play the more conservative. They say, hey, wait a minute. We don't add back fuel expense. We don't add back salary expense. And those are true cash outlays. If they buy this piece of equipment for $750,000 and they pay the cash to buy it, they're writing it off and they're dishing out the cash in the same year. So why would we add it back in? Like fuel expense, like salary expense, those are cash outlays, and we expense them the same way or the similar way. So why would we add this back? The more conservatives, we don't add them back in. Now, 40% of all commercial lenders in America today, roughly, and these are approximate numbers, 40% do add them back in, like everyone that has responded so far. Do add them back in. Here are two justifications to add back the Section 179 to your cash flow model. Even though the majority of commercial lenders, slight majority, don't, but here are two arguments. Say, hey, then we're going to argue this. These are two items. Here's the first one. The lender, you as a lender, your bank can say, we're justifying adding Section 179 back in, number one, because whose cash was it to buy that piece of equipment? The vast majority of the cash came from whom? Your bank. It did not come from ABC LLC or even Bob and Sue individually. No, it was your bank that did it in the form of the loan. If you do an 80 or 90% loan to value, or even 100%, even more, the vast majority of the cash, if not all of it, to buy that $750,000 piece of equipment came from whom? Your bank, not from the business or the business owners. So we'll add it back in. Here's a second argument. What if ABC LLC, the borrower, only buys equipment every maybe 5, 6, or 7 years? The nature of their business, they just don't need to replace the equipment that often. They're a small manufacturer, but it's the type of manufacturing that just, it's just kind of mainstay. They just don't need to replace. So wait a minute. This is like a one-time deal. It's an unusual, a non-recurring event. So why don't we add it back in? Just a thought. No matter what your bank does, though, I beg of you, be consistent. I mentioned this yesterday. I worked at a bank where we had 4 lending centers in the metro area. 3 of the 4 the teams, nobody added it back in. No, played it more conservative. One team says, we're adding it back in. What I'm trying to say is, you got the same bank, same management, same loan committee that all 4 lending centers will go to downtown to present. But you have different underwriting standards in the same bank, illogical. And it's in the same geographical, same metro area. I could see if the bank was spread over maybe like 2 states or 2 different areas of the state that are geographically way different and or economically way different. But that was not the case. It was the same geographic and the same economics. So you couldn't justify, well, a little different underwriting standard for this county versus this county, but we're consistent within each of those 2 counties. Does that make sense what I'm saying, Evan? Evan, if you're, I know you've got some of the technology, but if you're back, does that make sense, Evan?
Yeah.
You bet. Okay, great, you're back. So you and Mo and Dwight are back?
Yeah, we've been in and out. We're still having the same connection
Okay.
issue, but we'll
Okay,
try
well,
answering when we can.
Okay. Oh, no problem. I was just going to suggest that. I love it. Thank you, Evan. Thank you. Moving right along. And that happens with the technology. I understand that, of course. Let's move forward. The third and final depreciation is under part number 2. Special. This is called special depreciation, or what we're going to refer to it later as bonus depreciation. If you'll add this to your notes under part 2, special depreciation or bonus, pardon me, it used to be 50%. Now it's 100%. Used to be 50%. Now it's 100%. We'll come back to that in our strategy section. Like, what does that mean? 50% versus 100. Let me just suffice it to say right here, the special or bonus depreciation is extensively expanded, going from 50 to 100%. We'll come back to that. By the way, most all commercial lenders, if you see bonus depreciation or special under part 2, you would not add it back in. In my opinion, at least, it's way too aggressive. It's just too much. I would not add it back into your traditional EBITDA cash flow model. Turn forward, if you would. Couple of pages to the K1. Now, we're going to look at the K1 for the LLC partnership. This is the cash flow, of course, from the business, or the ultimate distribution from the business, or net distribution from the business to Bob, from the business to Sue. Each of them get a K1. We're going to see the K1 on the S Corp in just a moment as well. It's a little different form. Want to make sure we're reading the cash flow correctly. Here we go. On the bottom right-hand side of this page, where it says for IRS use only, we're just going to use that form. And this is simply just because it's a little blank section. Here is the formula. It's line 19A plus, this is the cash flow formula from the business to Bob, the business to Sue. 19A plus 4C minus box L, capital contributed. Line 19A plus 4C minus box L, capital contributed. So if you look with me, I'm just turning up, you can see 19. There are no letters because there are no numbers populating in this form. So 19A, distribution from the business to Bob, plus 4C up above, total guaranteed payment from the business to Bob during the year, minus box L, capital contributed during the year. So if you had 100,000 distribution 19A plus 50,000 guaranteed payment to partners minus 0 contributed back, his true cash flow from the business to the business owner and would be found in his personal cash flow would be 150,000. Okay. What if it's the distribution's 100, guaranteed payment is 50, but the capital contributed back was 25,000? the net cash flow would be 125. Okay. Now, just a little snippet on, well, wait, what distribution, capital contribute? That's pretty straightforward. But let's go up to 4C. What is total guaranteed payments to partners? In an LLC partnership, the owners cannot pay themselves traditionally a salary. They can pay salaries to employees, but not to themselves as owners. So it's sort of in my opinion, it's kind of semantics. Well, the total guaranteed payments, it's a guaranteed payment to the partner. It functions like a guaranteed salary. I'd add that to your notes next to 4C. Kind of an interesting concept. It's like a guaranteed salary, but technically it's not a salary. Can't be, because they're owners of the partnership LLC. Let's move forward. Let's go to the 1120S, the S Corp. Okay. Pardon me, the 1120S. We'll quickly do the cash flow model right on the front, and then we're going to go to the K1 in the back. So the cash flow model is, as you can see on your screen and right in front of you, if you'll highlight line number 21, net income, net loss, add back line number 13, interest, add back line number 14, depreciation, add back line number 19, other deduction, see the back of the tax form, amortization question mark, I'd put like we did before. And then lastly, add back line number 15, depletion. Now, we talked about this extensively yesterday. Of course, what's depletion? Well, it's like depreciation. Depreciation, fixed assets, vehicle equipment, buildings. Of course, amortization for an intangible asset, goodwill, trademark, what have you. Depletion for a natural resource, like depreciation for a natural resource. Timber, oil, coal, natural gas, you name it. Now, so once again, line number 21, net income, net loss, plus 13 interest, plus 14 depreciation, plus line number 19, amortization if it exists in the back of the return, and then line number 15, depletion. And then of course, before we forget, slash through line number 12, taxes. Just a reminder. That's just a reminder. That could be a legitimate expense, but it's not to be added back into the traditional EBITDA formula. Moving right along. Let's turn forward about
Hey,
5
David,
pages.
I actually have a question for
Go
you
ahead.
with respect to cash flow.
You bet.
So this is not how we do our standard cash flow. We do not utilize ordinary business income, and same thing with the 1065. We don't use that front page net income. We
Okay.
actually utilize book income from
Whoa.
the M1 line 1.
Excellent question, Andrew. Some lenders do that, and I don't agree with it. Now that's just this. Let me explain. But and I hear this around the country every once in a while. And the reason why is what they do is they use Schedule M1 line 1. But Andrew, correct me if I'm wrong, you still end up adding back in, for example, line number 13 interest, line number 14 depreciation, and so forth. Is that true?
Correct, as well as some adjustments within the Schedule M1, such
Yes.
as 3A, 6A, and
Yes.
now with PPP, I think
Yes.
it's 5A, right?
Yeah. And I understand that now, but what I want to clarify is this is the reason why I don't agree with it. And like I said, over the years, I hear this periodically. The reason why I don't agree with it is, in my opinion, it's my opinion only, you're mixing two worlds, because you're starting with the book income, Schedule M1 line 1, then you're mixing it with the world of tax. In my personal opinion, it's cleaner to use the front of the tax return and keep all of the information relative to in the world of tax. When you have, for example, this is year-end 20, you have a year-end 20 company prepared or even a CPA compiled, as an example, financial statement. use that as your cash flow model. That's your source document. You would start with the net income, add back like we've done and like we did yesterday. But in my personal opinion, when you take Schedule M1 and you basically mix it with the front page where you're adding back the interest, depreciation, amortization, depletion, in some ways you're mixing two worlds together. My personal opinion is to keep them separate. Source document, tax using the front. Source document, company prepared or company compiled or CPA compiled, whatever, tax or not tax, but financial statement. Company prepared, CPA compiled, CPA reviewed, or even audit for the same period. Two different cash flow models, two different source documents. What my opinion is, you're mixing two worlds. Does that make sense, Andrew?
It does. But yeah, I mean, we take like our depreciation and whatnot, and we adjust it back down to book. So we make appropriate adjustments, but I totally understand where you're coming from, because I've done extensive research to figure out why they do it that way. So.
Yeah, and a lot of it is, I'll just say it straight out. A lot of it is tradition. Some banks have done that for decades and decades and decades. And I've looked at it. I've looked at it. I've discussed it with many different credit analysts and loan officers through the years. And just my opinion only, just my opinion, I prefer to keep the world separate. The source document. I had a boss once that used to tell us, hey, I want you to take the tax return. I want you to take the financial statement for the business for the same period. And I want you to take the higher of the two numbers. And we're going to have strong cash flow modeling as long as you're on my team. That's how we're going to do it. And I used to think, what? So his idea was not like you're doing, Andrew. You're taking Schedule M1 and you're truly taking and adjusting to come up with your cash flow. No, this old boss of mine, his attitude was, no, we're going to take the tax return right on your desk, the financial statement on your desk, and whichever is the higher number, like for example, pardon me, for interest or depreciation could be adjusted, interest not, but like number 14, depreciation could be a little different. You take the higher of the two. And we looked at him, we go, what? All of us as lenders, and he was our team leader, and we go, what? He just looked at us and he goes, we're going to make loans on my team. I want strong cash flow models. We need loans on the books. Well, part of the reason why he did this is because he was getting pressure from senior management at the bank to do what? To quote unquote slang term, to beef up the loans, to increase our volume. And he was just desperate. He says, somehow we have got to get more loans on the books. So his way of doing it was basically, we're going to just take the higher of the two and basically fudge on the cash flow and make up essentially, to a degree, artificial cash flow modeling. Why? To justify bigger loans, to justify approval, if you will. Does that make sense? All that I said, Andrew, does that all make sense?
Yes, sir.
You bet. By the way, what did my coworkers and I say? Not in the presence of our team leader, but of course, when he was out of the office, we all got together and says, wait a minute, okay, we understand he's getting pressure from senior management to increase the loan volume. But we can't be fudging our analysis. It's going to come back to bite us. It's going to come back to bite the bank, and it's going to come back to bite us individually. So it put us as lenders, as commercial lenders, in a real bad position, if you will, a real bad position. It was tough because, and you said, well, how did we handle it? Well, we just did the best we could until what happened? A few months later, senior management backed off, took the pressure off our team leader. All of a sudden, he comes back from one of the senior management meetings, and he comes walking into our commercial lending team, and he says, Oh, the pressure's off. And all of a sudden he just looked at us and says, hey, let's just keep doing our normal underwriting. In so many words, forget what I told you a month ago, 2 months ago. What had happened was senior management realized some of those goals they had set were unrealistic, meaning loan growth goals. And enough of the managers complain and says, hey, this is not realistic, meaning the team leader, commercial lending team leaders. So senior management backed off and kind of, quote unquote, did a polite reversal and took the pressure off everybody on the entire chain, if you will, of command. Moving right along. Very good, Andrew. Very good point. Let's move forward. Now, let's go about 5 pages or so to the K1. The K1 for the S Corp. We'll take this one and then we'll take our second break of the morning. Okay. So we're on, if you just fast forward about 5-6 pages, we're on the K1 for the S Corp. Little different format. In the bottom left-hand side in that blank box, pardon me, if you'll please add this to your notes, the formula, the cash flow formula. And let's say that Sue owns this S Corp by herself. Pardon me, so there's just one K1. It's the formula of the cash flow is line number 16D minus capital contributed. Line number 16D minus capital contributed. So you can see 16 is blank. Well, if there are numbers, it would be populated. But it's 16D is the distribution from the business to Sue. Let's say it's 100,000, just to keep the number simple. But nowhere on this form do we really see the capital contributed back to the business like we do in the K1 for an LLC partnership under box L on the bottom left. That doesn't exist. Now, some individuals will say, well, I could go back and schedule M2 and kind of figure it out. And I can go to the balance sheet, kind of figure out, did they contribute anything back? Well, my recommendation is that you ask the CFO, Jane. Jane is the CFO for Bob and Sue's company, ABC LLC, but they ultimately own, like a lot of your borrowers in real life, 3, 4, 5, 10, 20 different businesses. Jane will traditionally serve as the CFO for all of them, most likely. You go back to Jane. Jane, can you confirm, did Sue contribute anything back to the business? She says no. She looks it up. She may just no. She goes no. Now you may say, well, if it's on the tax form, we can tie into that. Do we just take Jane's word for it? Well, that gets back to the most basic of credit, the 5 C's of credit, and the fifth of the 5 C's is character. We've got, if we don't trust Jane on something that, in my opinion, that basic, hey, did you contribute anything back? Yes or no? No, she didn't. Okay, if we don't trust her, well, wait a minute. Should we be doing business with Bob and Sue and Jane? Just a thought. Any questions on the K1? Reading the K1 for the S Corp, which is once again a little different than the K1 for the LLC partnership. Any questions? Charisma, any questions on this?
No questions.
Got it. Thank you. Catherine Lee, any questions?
Nope, none for me.
Thank you. Let's go ahead and move forward to the 1120, the C Corp. We'll stop right there. Let's take another 5-minute break and we'll come on back. Talk to you in 5 minutes. Thank you. Welcome back, everyone. Take just a moment. We'll get started. Okay, Joey, are you back with us? Can you do our sound check, please?
Yes, I'm here.
Excellent. Thank you for doing that. Now, the 1120, before we go into 1120, I just had a thought. This is based off of Andrew, your comment and that the way you've got a format on your cash flow model, you use the schedule M1 and so forth. Well, I need to say this. Some of your banks, you have a very set format in the cash flow modeling. And as I worked in various banks when I was on your side of the table, and even today as the CFO interacting with the lenders, with my clients, my CFO clients, and interacting with them, some banks have a very relatively rigid format of their cash flow modeling. And Andrew, I'm not saying your bank is necessarily rigid, but the conversation we had just kind of during the break, I thought about this, and I thought I'd mention this to the class. Some of your banks have a very rigid format. It may be that the credit administration says this is the way it's going to be. You will do this cash flow model this certain way. Other community banks have a lot more freedom, a lot more flexibility, so that it becomes the cash flow model becomes actually more real relative to the actual company / borrower / loan request. I will say this, a general observation. The larger the bank, traditionally, the more set the cash flow model will be. Just an observation. Small little community bank, freedom all the way. And which I personally like, because it mirror images more the real borrower, the real circumstance, the real loan request. Sometimes, looking back in my B of A days, you did B of A, Bank of America. And if any of you have ever worked at a big bank, B of A, Wells, Chase, Citibank, generally, not always, but generally speaking, you do it their way. And you do not deviate in that format in any way, shape, or form. You do it our way. In fact, when I was at B of A, I actually worked at it was a regional bank that B of A bought. And oh man, when B of A came in, it was like, your modeling, your cash flow modeling, your forms, your Excel, throw that out. And in fact, they even sent us to a week-long school in California, all the lenders that were in banks that were being merged or bought out by B of A, so that we were taught their version. And we would joke, the B of A way, the B of A way. And we all came from predecessor banks. So we had all the input, but part of it was so that there was continuity, if you will. So, and I understand that. From a big bank perspective, you've got to have a certain level of continuity. The positive, it's everyone's marching in the same direction. The negative is, as most of us realize, every deal may be a little different. And there will be circumstances in the cash flow model that doesn't necessarily fit the form. Just a thought. Evan, any comments on that thought that I had, that I just mentioned? Any comments, questions, or comments on that? Does that make sense what I just said? Evan, I guess the technologies, it's acting up again. Catherine Walker, any comments, questions on what I just mentioned? Does that make sense what I just mentioned?
It does make sense. So I understand, coming from a larger bank also, that if it doesn't fit in the box, they're not going to do it.
Oh yeah. It's just like, it doesn't match our world. What? In fact, quite frankly, and this is just a general statement, not just in cash flow modeling, although.
Sorry.
Okay.
We're still going.
Okay, you're there. Okay, good.
But yes, that does make sense. No questions here.
You bet. Okay, thank you, Evan. And Catherine, back to Catherine Walker, you're the concept that so you've seen it. You've seen the more rigid big bank, and then the flexibility. That is one big benefit of the community bank. traditionally, in a general statement, in a general way, over the community bank, the small community bank versus the big bank, or even a big regional bank, is the flexibility. Absolutely. My personal opinion, the flexibility, if I'm not saying we do quote unquote fake underwriting, or like I've illustrated my old boss that let me rephrase it. It's not fake underwriting, it's called creative underwriting or creative cash flow modeling. In fact, we would even tease, we would say, oh, so-and-so, our team leader, his name was Greg. Oh, well, Greg's doing another creative cash flow model. Well, I'm not saying that. I'm not saying to do that in the community bank, but I am saying the flexibility and to match the actual deal is better. Moving right along. Let's go to the 1120, the S Corp, the cash flow model. Okay, we'll start with line number 30, taxable income minus 31. Total tax gives us the net income or net loss. Add back line number 18, interest. Line number 31, total tax. Line number 20, depreciation. Line number 26, other deduction. See statement in the back. See statement in the back. If there is any amortization, pardon me, and then add back line number 21, depletion. Number 30 minus 31 gives us the net income, net loss. Remember, the C Corp is a true taxable entity versus the LLC, partnership, and S Corp. No, those are pass through. And we add back interest, line number 18, interest, line number 31, total tax, the EBITDA, EBIT, DAD, 20, depreciation, 26, amortization in the back, 21, depletion. Now, some underwriters, if you touch a C Corp, you basically, they'll start with line number 30, taxable income. Don't take out 31, but don't add it back in either later on. And you're going to be the same number. Just a thought. 30, you don't subtract 31, but you don't add it back in either. Now, I dare say that the vast majority of our class, you don't even really see that many C corporations. Let's do a class shout out. Yes or no? The yes is, in your mind, just say yes if I don't see very many C corps. No is, oh no, I see a bunch. I see a whole bunch, a whole lot. Yes or no, do you see many C corps? Yes or no? If you say, let me rephrase it again. Let me make it simpler. If you say, no, I don't see many, let's just say no. If you say, oh no, I see a lot, you say yes. Do you see many C corps? Do you see many C corps?
No.
No.
Okay.
No.
No, not many. Not many.
Sometimes.
Sometimes we've got a sometimes. Bob says no in the chat. Jeff says no in the chat. Excellent. So most of you don't. A few do. And you may see him every once in a while. Why? Well, it's because most of your borrowers in a community bank are small to medium sized, privately held businesses owned by whom? Bob and Sue. Absolutely. Excellent. Now let's go ahead and go back. If you'll put exhibit 2 to the side, if you would please, and go back to the main PowerPoint presentation, please. So I'm going to stop sharing that. And if you'll go ahead, go with me back to the main PowerPoint. Okay. All right. You should be back on page number 7. Now, you'll turn forward with me to page number 8. We are now entering our second area, main area for today's presentation. Tax strategy for the small to medium-sized business owner. Now, we've already really covered a lot of this. So as we go through these models, we're going to simply add to, or I'll say, hey, remember we talked about that back in the form when we looked at the actual tax form, and away we go. Tax structure is huge in this intro going into the second area of tax strategies. And this was, remember, the bullet point number 2 or section 2 all the way down to number 8 in our kind of our outline, if you will. Now we'll start into tax strategies, and we'll go into this just a little bit, and then we'll take our lunch break in a few minutes. The C Corp, I'd put off to the right. What can we add? We know it's an 1120. We just covered it. Form. I'd add this to your notes, double taxation. The C Corp has double taxation. Okay. The corporation pays tax on its profitability. Then it turns around and distributes after tax the dividend, a dividend to the shareholders. And the shareholders have to then pay tax on the same dollar amount, on the same dollars, not the same dollar amount, but the same dollars. Corporation pays tax when it's profitable. After tax, distribute the leftover, the after-tax profit in the form of a dividend to the shareholders. Shareholders have to turn around and pay tax on the same dollars. Huge negative. Let's go to the S Corp. 1958, the first S Corps came about. What? Why? The spirit of the S Corp, no double taxation. The pass-through from the business profit and or loss to the individuals, to the shareholders. But there are limitations. Back up under the C Corp, I'd put a little note back up on the C Corp, unlimited number of shareholders. 10,000, 20,000 shareholders, Microsoft. Oh, absolutely. It's big publicly traded C Corp. Essentially all publicly traded corporations are C Corps. How about the S Corp? What's the limitation? 100 shareholders max. It used to be 35, then went to 75. Just over the last few years, now it's 100. Here's another caveat relative to the S Corp. You can have 99 non-family members in a family-owned S Corp. And the one family member in a family-owned S Corp, the one family member represents the entire family, 20, 30, 40 people, up to 6 generations of the same family. Literally, that's the structure of the S Corp. You can only have up to 100 shareholders, but if it's a family-owned S Corp, 99 of those 100 could be non-family. One family member represents the family. Could have 20, 30, 40 people involved, all represented by the one person, up to 6 generations of the same family. I was training in the Midwest, ground-based, a couple years ago. One of the credit analysts came up to me during the break, one of the breaks, said, "You're not going to believe it. My bank is an S Corp." I said, "Really?" I looked at him and I just was teasing him. I said, "Well, let me guess, 100 shareholders." He goes, "Absolutely." I go, "No way." We both started laughing. I go, "No way." He goes, "Yeah, 100. I said, "Okay, well, wait, tell me about the structure of the family." Because he goes, "I work at a family-owned bank." And then he says it's an S Corp. And he goes, "Well, grandma," and that was literally the grandmother of the family. He goes, "First off, it's a third or fourth generation bank. It'd been around like 85 years plus." And he says, "Grandma controls all the stock and she holds it for the entire family." And I said, "Okay, you literally have 99 non-family member shareholders." He goes, "Exactly to the T." And I said, "Well, how many of the family members work in the bank?" He goes, "Almost all the employees." He goes, "And it was a small community bank." He goes, "About 30. I said, "Are you one of them?" He goes, "No, unfortunately, I'm not part of the family, but I'm an employee." Of course. Interesting. Very interesting. Let's go to the LLC, limited liability company. Partnership we've emphasized, but the LLC could be a C Corp, S Corp, or even a single member LLC. Okay, if you'll add this to your notes, this is strategy. You do not, I beg of you, do not give this tax advice to Bob and Sue directly. but indirectly you can. If you have a client that has a Schedule C, a sole proprietorship, or even a single member LLC, statistically, please add this to your notes. They have a approximately a 4 times more likelihood, of being audited than a separate 1065 partnership LLC tax form. A sole proprietor or a single member LLC this files, both of them file as a Schedule C, there is a 4 times more likelihood that they will be audited than a separate freestanding 1065 tax form. Let me illustrate. Dr. Jones is a brain surgeon, okay, in Milwaukee. Okay. She makes $1.2 million a year as a brain surgeon. She's a photographer also. That's her hobby. Someone says, well, hey, do you write off that? Well, I charge a little bit, but she spends about 20, 30,000 a year for supplies and so forth. It's a full-scale hobby. She loves it. It's the way to unwind from the pressure of being the brain surgeon. Well, for her, for other people, it's golfing, it's fly fishing, it's whatever. But for her, it's photography. So she puts it on her Schedule C, whether it's a sole proprietor or a single member LLC. The IRS looks at that tax form and says, wait a minute, Dr. Jones is a brain surgeon, neurosurgeon. She makes $1.2 million a year. And she's got this Schedule C. That's a hobby business. Disallow. No way. Okay, now this is the strategy. If you have a customer that's a single member LLC, you say to them without giving tax advice, well, I noticed you file a Schedule C, it's a single member. Yeah, I own it 100%. Well, sometimes whether or not it's a hobby business or not, that Schedule C gets scrutinized a lot more than a separate freestanding LLC partnership. And they look at you like, well, what are you doing? And you just say, well, some of our bank customers do this. They get what's called a shadow owner. And you tell them they give a whopping 0.005% ownership to a spouse, a family member, their CFO, Jane even. I've been the shadow owner of several of my clients, LLCs, a 0.005. Am I liable for their loans? No. Do I have to sign the guarantees? No. It's just the slang term is window dressing. But you get them out of the crosshairs of the IRS. Just a thought. Because now there's 2 members. Now, by the way, George, the independent CPA, he doesn't call them members. He calls them partners. Why? Because most of his LLCs are partnerships, or they're related to the 1065. We call them members in the bank. CPAs usually call them partners, meaning the owners of the LLC. Joey Hallman, does that make sense what I just said? That strategy.
Yes, it does.
Okay. Thank you. But we don't tell them you do this and we don't control. If we start to control our borrowers, we're going to quickly enter the world of the double L. What is the double L? Lender liability. And we don't want to go there. No way. But we say to them, and just say, well, some of our customers, because some of your customers will do that. They will have a shadow owner, a smaller, it may not be a 0.005 or 1%, something like that, or 5%, something very minuscule. And then the rest of the ownership is really like the Dr. Jones of the world. What's a series LLC? Okay, Bob and Sue's company, ABC, let's say for just a moment, they're not a manufacturer. They're a commercial real estate developer. They have buildings, they have 10 commercial buildings all over the Grand Rapids market, both sides of the river, both sides of the river. Okay. How do I know about the river? Well, a couple of years ago, I trained the CPAs, trained them in Detroit area, but I've trained them in Grand Rapids at the university, right there off, right next to the river, in the building there. And some of the CPAs says, oh, you won't believe it. I haven't been in this building since I got my degree from here. Interesting. Now, 10 buildings all around the Grand Rapids market. Okay, now, instead of having 10 different LLCs, modern America, about 20 states allow it. The last time I checked with some of these seminars, webinars with Michigan and Wisconsin, correct me if I'm wrong, I believe Wisconsin allows it, but Michigan doesn't. Ooh, but I need everybody to grab your phone if you would. If you'll grab your individual phones and just look up Series LLC. Is a Series LLC allowed in Michigan, is allowed in Wisconsin? I believe it's allowed in Wisconsin, but not Michigan. But see, it's updating. You know, it's a moving target. In other words, it used to be only 4 or 5 states allowed. Now it's up to about 20. So please grab your phone if you can look it up and see the list. And then I just need to have you, a few of you just blurt it out. If you can just open your mic and just blurt it out, yes or no. If you know, Michigan, yes, Michigan, no, Wisconsin, yes. I believe it's that way. At least the last time I believe. Then we'll come back to and explain a little deeper. Well, what is this? What is this newfangled LLC? Okay, we have a volunteer that will just unmute and just tell us per what you see on your phone. Series LLC, and it shows the list of the various states. Last time I believe Michigan's no, Wisconsin's yes.
Wisconsin is yes.
Okay, Wisconsin's yes. What about Michigan? Are they in the list? Is Michigan in the list?
Doesn't look like they're on the list.
Okay,
no.
So I recall Michigan is no now. Right now, Wisconsin's yes, but it's moving forward. It's, in my opinion, it's just a matter of time before all 50 states allow it. By the way, when the first LLC was created, it was 1977 in the state of Wyoming. Wyoming is one of the 3 states that have that have a lot of flexibility in their structure, business structure. Wyoming, Nevada, and Delaware. Those are the big 3. 1977, but it took until the mid-90s before most states allowed the basic traditional LLC that, fast forward to today, is everywhere in America. So in my opinion, it's just a matter of time. About 20 states, if you look at your list, there's 15 or 20 at least. Now, what is it? Let's go back to Bob and Sue. They have the 10 buildings around the Grand Rapids metro area. Traditionally, they'd have 10 different LLCs. Well, if Michigan adopts the Series LLC, they could have one LLC, which is like a master LLC, which is the Series. Property 1 will be in pod A, property 2 in pod B, property 3 in pod C, all the way down to number 10. Wow. 1 filing, 2 K1s. Why 2 K1s? 1 for Bob, 1 for Sue. Whereas right now, you got to get 20. Why 20? 10 different LLCs, 1 each, 20 of them. Wow. Series is the wave of the future, especially if you have a commercial real estate developer or investor as a client, like Bob and Sue, this new version of Bob and Sue. They're no longer manufacturers. No, they're commercial real estate developers. 1 tax return. Some states will have buffer between them, liability. Every state's a little different. Every state's a little different. Okay, we'll wait. Okay, Bob, here it is. Bob found listed. Wow, okay. In the chat, Bob says August 27th of 21, Wisconsin is not on the list. Okay. 14 states. Okay. But I believe, Bob, I don't know. I thought Wisconsin was yes and Michigan was no, but you may be right, Bob. We'll have to see which the date of the list, which is the most updated. Good. Needless to say, if Wisconsin is still not, Michigan is not, it's a matter of time, at least in my opinion. Okay, he's got even a reference there you can see in the chat. Good. Thank you, Bob. Excellent. But it's a matter of time that all 50 states, similar, in my opinion, similar to what happened when the LLC was first created. Took time, took several years before every state adopted it. One last one, we take our lunch break. REIT, Real Estate Investment Trust. Usually these are large, mega $1 million projects. Can be taxed as a partnership, LLC, C Corp, S Corp. They can be publicly traded. They could be privately held. Real Estate Investment Trust, or REIT for short. Excellent. Now let's turn to page number 9. We'll stop right there and we'll take our 30-minute lunch break. Come on back and we'll continue forward in our strategy. And like I mentioned, like for example, you can see 179. These areas we've already covered. We'll go through a little quicker, but we're going to add to it and shift from more of the form concept or looking at the tax form to more pure strategy. Have a good lunch, everyone. Talk to you in about 30 minutes. Welcome back, everyone. We'll take just a moment and get started. Pardon me.
Hey David, this is Tarshi. Can you hear me?
Who's this?
Tarshi.
Oh, Septarshi. Hey. Oh, okay. So you're no longer in the chat?
Yeah, so what happened was Zoom meeting kept on crashing my VPN. I was working from home, but I decided to just scrap that. I drove over to the office. I'm working from the office right now. So.
Okay, great. Thank you, Septarshi. Good. So I'll take you off the chat. Thank you. And you've done our kind of the test to make sure we're back up, if you will, sound check. So thank you for doing that. Welcome back, everyone. And before we get started and move forward in our strategy section, are there any questions that I can answer before we move forward? Just any questions from the material so far today? Okay, well, let's go ahead and continue. Here on page number 9, we go into the strategy of depreciation. Now, we've talked extensively concerning makers, Section 179, and special or bonus depreciation. You can see in 2017, before the TCJA kicked in, or the Tax Cuts and Jobs Act, pardon me, you can see in that first paragraph here on page number 9 that it was basically only 500,000, 510 and 17, and a $2 million. Remember, in 21 right now, this year we're in right now, it's $1,050,000, and it's a little over 2.6 million. So the numbers have definitely increased, including and in particular, the amount of depreciation, or the amount that can be written off, depreciation of the asset, the equipment, in one shot, basically doubled from 500,000 to $1 million. Now over the last few years, ratcheted up to $1,050,000. Look at bonus depreciation. It was only 50%. Okay, now at the bottom of this page, page number 9, if you would please put in your notes, equipment, new equipment. To the right of that, if you'd put, and this is right at the bottom of page number 9, pardon me, please, new equipment to the right of that, $1 million. Okay, under the old plan, the first thing you would do is you would take right below new equipment, if you'd please put Section 179 depreciation, Section 179. And to the right of that, if you'd put 500,000, just to round the numbers, that leaves 500,000 left over. Then the second strategy would be the 50% bonus or special depreciation that we discussed about earlier. That would be 250,000, leaving 250. Okay, so if you'd put bonus or special depreciation 50%, 250, leaving what's left over, if you just subtract that off, 250. Third form of depreciation would be makers, the modified accelerated cost recovery system, which of course is a 5-year, and let's just say it's $100,000. Let's say it's 100,000. So 100,000 leaving 150,000. In one tax year strategy, your borrower could could purchase $1 million piece of equipment and write off 850,000 in one shot. Now that sounds great, but it's nothing compared to today. Turn the page forward to page number 10. Today, once again, in 2018, the TCJA went up to $1 million with purchases up to 2.5 million. Now, fast forward from 2018 to 2021 right now, as we mentioned, the million is now up to $1,050,000, pardon me, and the total purchase is a little over 2.6 million. So at the very bottom of this page, if you put in your notes, new equipment, $1 million. Well, Section 179, $1 million, you're done. You're done. Just one simple technique. It's not the three combined. Now, wait a minute. What if you have a $2 million piece of equipment? I put that in your notes at the bottom of page 10. $2 million piece of equipment. From a strategy standpoint, your borrowers, Bob and Sue, ABC LLC, now we'll shift them back to the manufacturer. They were temporarily commercial real estate developers to illustrate, pardon me, as we talked about earlier, the Series LLC right before the break. Well, if it's a $2 million, you could take $1 million off, technically $1.05 million this year, but let's just round it to $1 million, which then leaves another $1 million. Well, what about that other $1 million? Look at the second paragraph down. The special or bonus depreciation increased from 50 to 100%. Wow. So 50 to 100%. So that extra $1 million could be written off. All of it can be written off. The options with depreciation from a strategy standpoint, the tax deductibility is huge today. Now, I'm going to say this, and we said this yesterday. We don't want, typically, the strategy of your borrower is not always to just completely always write off the asset, meaning in one shot. Why? Well, because, or any of these tax strategies, if they take too many of the tax deductions, if they take too much, they're not going to have that much income, if you will. Now, even if we add back, and so forth in the EBITDA formula, well, there still are situations where, boy, there's not enough cash flow to substantiate or to justify the loan. So the old adage, like we talked about yesterday, the borrower wants to see, or wants, the borrower should, and Jane, the CFO, can help Bob and Sue do this with, of course, some input from George, the CPA. But Jane, she's good. She's very good. And she's got a good background in tax strategy, even though she's not the independent CPA. She knows there's an old saying. We've got to show enough income to justify or to get approval on the loan or line of credit, but not so much that we pay through the nose to the IRS. So there's a happy medium. A good, solid CFO like Jane will help Bob and Sue strategize. Hey, we're going to take enough write-offs so we don't get clobbered on the tax, but we don't bring it down. We don't write off so much that we cannot show or substantiate enough cash flow for you, the commercial lender, to get approval. There's got to be a happy medium, and there can be. Once again, a good, solid CFO like Jane can do it. She really can. Of course, with input from George and even input from Bob and Sue, the owners. Moving right along, page number 11. Capital gains, capital losses. We use the example of stocks when we reviewed Schedule D, but it could be bonds, real estate, what have you. 12 months or more, we saw that typically. Look at the tax rates, 0, 15, and 20%. Now, this is jumping ahead towards the end of our session. As part of the proposed, and these are just proposed, these are not even officially proposed, but these are just hinted to, various increases in tax. Here's one I'd put off to the side of 20%. There may be a fourth tier added to the capital gains structure. 0, 15, 20% is existing. Pardon me, what we may see to pay for the various stimulus packages and all these various $1 trillion programs, as I mentioned earlier, may go up to 39.6%. There may be a fourth tier at 39.6%. Now, of course, a person that earns not, relatively small dollar amounts has a capital gains, probably won't pay any tax, 0, or maybe 15%. Typically, the 20% is a much higher tax bracket. We'll see this in Exhibit 3. But there could be added a fourth tier. What's AMT, alternative minimum tax? In the tax code, and let me illustrate this. I had a client when I was on your side of the table. He owned and operated a very high-end engineering / manufacturing firm. It was what I would call a boutique operation. They engineered, so they developed and manufactured both very high-end gaming equipment. And they would export these, to Australia and all over the US for the various casinos and all over the world. The gaming equipment today, people oftentimes don't realize how high tech that is. Well, he was on the cutting edge. Well, he took every advantage of what we just talked about on the previous page, depreciation, up to the max. He'd show no tax. He'd show no income, so no tax. Well, I was able to add back, the depreciation and on, all the different things we're talking about today. So I was able to justify his cash flow was actually $1 million a year. Not bad. Well, what does AMT do from the tax standpoint? Not the cash flow, but the tax. Pardon me, it quote unquote forces someone like this that shows no income and therefore no tax to still pay a little bit of tax in the system. Look down below passive activities, such as a rental property. What do you mean by passive? Well, it's similar concept to capital gains. It's typically not the main activity of the individual, the main cash flow, although it could be. It's more the passive with the real estate. Now, this brings us into, or leads us into our next huge, major section. Real estate strategy. This is huge. Real estate strategy. Okay. Now, we're going to start on the personal, and then we're going to shift partly through the real estate section to more the business or commercial real estate. Now you're saying, well, why are we doing the personal? Well, it's because most of you deal with the Bobs and Sues of the world. You deal with your commercial lenders, so you lend to the business, but you're obtaining the guarantee of Bob and Sue, the owners, the principals. You're dealing with them, maybe even if they need a car loan personally, or or a home loan, you'll process that, or get them to the right department within your bank. And from a tax standpoint, even though you're a commercial lender, in my personal opinion, you need to know the a commercial lender, you need to know the personal side of the equation, because it ties. It ties because it's Bob and Sue. Look at the top right-hand side of this page. There is in the tax code a $250,000 exemption for a single filer, $500,000 for married filing jointly. Okay, this is huge. This is huge. This has been in place actually for several years. This is even before the TCJA, Tax Cuts and Jobs Act, which became effective once again 1/1/18. Look at this. Look at this illustration on these numbers. These were numbers generated from a family member of ours' personal residence in California about 4 years ago. The house literally looked like you see in the little picture on the top right-hand side of the page. Their house. In fact, that's why I picked it. When I was looking for some examples, It looked almost just like that, 2-story, about that same, a little different, but the chimney was on the right instead of on the left where this picture is, but, and the pool was almost verbatim, just where it is. They sold the home for $1,150,000. This home sits in the middle of Silicon Valley in the San Francisco Bay Area in San Jose area, California. One of the highest priced, if not the highest priced markets in America. Now, that was 4 years ago. Just a week ago, and this was just a fluke, a family member of ours said to me, another family member, now, wait a minute. I'd like to see the old house. And all I did was put the address on my phone and it pops up. It popped up and it was the right house. Because they said, oh, and there was a question on the house and it was a different family member, not the family member that sold the home. And the thing that I couldn't believe is the value or the dollar amount that the house is now worth, legitimately worth in the open market. Okay. I'm going to ask each of you, I'm going to call on a couple of you to just take a guess. 4 years later, less than 4 years later, this house it's sold for $1,150,000. How much is that house worth today? Now you could argue and say, well, if it's on your phone, that means it's on the internet. Yeah, it may be inflated 100,000. Okay, whatever, fine. But I find that sometimes these numbers are starting to get very accurate. Kind of interesting. Think for just a moment. In less than 4 years, what is this house now worth as of right now, today? Less than 4 years later. Graham, I'm going to ask you, Graham, just throw out a number. Just take a guess. Just throw out a number. What is the value today on this same house?
1.6.
1.6 million. Thank you. Jack, how about you?
I'm going to say 1.4.
Say that again, 1.4 million. So we got 1.6, 1.4. Mickey, how about you? Mickey?
Yeah, I think, I would be surprised if it was maybe appreciating at 10% a year. That would be a lot to me. I could see that happening, maybe 1.7.
1.7. Okay. Dylan, what about you? What would you
I'll
say?
go a little higher. I'll go 1.8.
1.8. Heather, we'll ask one more person. Heather, what would you say? Just take a guess.
I'm going with 1.5.
1.5. $1,750,000 in 4 years. Less than 4 years. Wow. And it's real. Oh, it's very real in that market. Now, let's go back to the numbers. Thank you for that. Thank you for those guesses. Now, sold for $1,150,000. Sales closing costs. This is part of the basis. Boy, knock that down. Original price. Look at the original price. 30-something years ago. 107. Sale, the improvements to sell it, 85,000, just cosmetic. You think 85,000, it was just still cosmetic. Wasn't like major, like an addition to the home or something. Improvement over time, 100,000, knock that basis down, pardon me, to 743. Wow. Okay. Married finally, jointly, you take off 500,000. Bob and Sue come to you. They live in Grand Rapids. Okay, let's see. I got to make sure I've got it right. Okay, Jordan, we're going to go back to Jordan. You live in the Grand Rapids area. Is that correct?
Yeah, that's correct.
Okay. Can you give us just a feel for the average price home in Grand Rapids? Just, an average price.
Probably 300,000.
Okay. Let's bump it up to 400. That's a little higher end. If they're in Grand Rapids, Jordan, they take the exemption 500, they're done. They're done. They don't even have to, you don't even have to exclude from the basis, the original price or the improvements or any of that. It's just a mathematical, well, okay, the average is about 300 and theirs is about 400. So you're meeting with Bob and Sue this coming week on a new loan request. And all of a sudden, Sue blurts out, we're thinking about selling our home, moving to this other part of town in Grand Rapids. Okay. She says to you, oh, I know you're not our CPA, you're not our tax advisor, but do you remember what the rules are for personal residence, not a rental, personal residence? And you just say, well, married, finally, jointly, it's a 500,000 exemption. Now, you didn't give them advice, you just told them information. She'll say, oh, well, we're thinking the house will probably sell for about 375 to 400. Oh, we're not going to pay any tax. And you don't say, well, yeah, and you don't start, acting like they're CPA. No, you simply say, well, that's it. That becomes added value to you and your bank versus whom? The competition down the street. The next day, they're with this other banker. Hey, we're thinking about selling the home, Sue blurts out. Do you remember what that exemption was? Don't really remember that. You need to check with George. Moving right along. We want added value to you. Look at the net, 243,000. Federal and state tax, leaving 60,750. Now this was the projection up front. Okay, I'm going to ask a couple of you just to take a wild guess, just to stab at this. How much do you think in the end they actually paid tax on this transaction? How much did they actually pay? The projection was no more than 60,750. How much do you think they actually paid? Think about it just for a second. I'm going to ask a few of you just to throw out a guess. Okay, here we go. Matthew, what do you think they actually paid?
I'm going to undershoot it, probably say 30 grand.
30 grand. Thank you. James, how about you?
I'm gonna go with like 45 grand.
45. Alonzo, what would you say?
I was thinking about 45 also.
45 also. They end up paying just about $43,000 on the table. Whoa. But you do the math. Wow. If they didn't have that exemption, that would hurt. That would hurt. Thank you all for the feedback and comments. Move forward. We're still in real estate. We're still on this actual transaction. Turn to page number 13. Look at this. Look at the proceeds to the seller, our family member. We have a picture of this family member sitting with a check for over $1 million, just sitting there smiling. A check. Old school. Oh, don't wire that money to my bank account. Oh, no, I want a live check. FedEx to me. I said to this family member, I said, wait a minute. You don't want this wired? Oh, no. I want a live check. Look at the reserves. I had them reserve that money. Did they end up paying it? No, they didn't pay 460, or they didn't pay 60,750. They paid about 43,000 and change, right in that range. Tax on one hand, cash flow on the other. Okay, now let's keep going. This is even further strategy for Bob and Sue individually. But once again, they look to you. Oh, you're not just their commercial lender, you're their financial advisor. Page number 14, look at the strategy. Move into the house for 2 years. Now, what does this mean? I'd highlight that under part B. Bob and Sue live in a house. They vacate the house, buy another home. They turn the first home into a rental property. And then the market booms. And they realize, wow, if we sell that house that's now a rental, we're going to have a sizable capital gain. Oh, yeah. So what do? They move back into when the lease is up, the next time the lease comes due on the rental, pardon me, they move back, and it's been several years. It's been a rental for like 10 years. They move back into the rental and live there for 2 of the last 5 years. That's in the third paragraph down. and then they sell it. And guess what? They sell it as their personal residence. They get the capital gains, or pardon me, they don't pay the capital gains. They get the exemption we just covered. 500,000 married filing jointly, 250 single filer. This is huge. This is huge strategy. Now, what I'm going to say, I would deny I ever said it. I train the CPAs. I train the CPAs on one of my classes, full day class. And I'm on the faculty of California, a CPA Education Foundation, the big, huge main organization in California. I've been for years. Well, I mentioned that yesterday. Well, I will mention this in front of the CPAs. I've had a few CPAs over the years, more than a few actually, laugh and under their breath say, you don't need to move back into that house. You get your adult kids to move back into that house. What? You get your kids to be the tenant and you still take the write-off. Now, is that fudging on the rules? Absolutely. But I've had more than a few CPAs say that to me when we go on to page number 14 right here. Oh, you don't need to leave your home and move back in. You just stick one of your kids in there, your adult kids in there, and they live in there. They're your representative, and then you take the write-off. Now that's obviously skirting around the tax code. But to do it legitimately, Bob and Sue leave their residence or sell that, move back in, live there for 2 years, sell it, and away we go. And they get that huge exemption. Questions on that? Alexa, any questions? If you can type into the chat, do you have any questions so far on the residential real estate strategy? Any questions, Alexa? Okay, you'll just type that in if you're there. You can help us there. Okay, here she goes. Here she goes. No questions. Thank you, Alexa. Okay, now let's move forward. Look at the bottom of the page. Just a few other tidbits. Still on the residential. On the primary loan, meaning the first mortgage, not the HELOC or home equity line or home equity loan. The points you can see down below, points, interest, and even the PMI is still tax deductible. We're going to see this in the tax updates in Exhibit 3 later on, where the PMI, private mortgage insurance, is still tax deductible. Now, what is PMI? Jordan, what is PMI? Can you describe PMI for everyone?
It's extra insurance that the bank makes you pay for, basically, if you're over 80% LTV.
Good. Excellent. If you've got 20% down or more, meaning your loan to value is 80% or less, you don't pay it, but a lot of people do. And it's an extra 50, 75, 100, 125, 150 a month. You're paying the premium on the policy, right, Jordan?
Correct.
Yeah. So what do you mean the premium? Well, in case you default, the lender gets paid off by the insurance policy. That's like not too much risk on behalf of the lender if you think about it. I mean, wow, that's not bad. Look at the last little paragraph at the bottom of this page. Home equity loan, home equity line interest is no longer tax deductible starting 1/1/18. What? Oh yeah. Used to be, when I was on your side of the table, we would, I would do home equity lines all day long in one particular department I was in. Oh, all day long. Now, the home equity line of credit or loan, the only exception now is if the money is used to make substantial improvements to the property, such as a new roof, a new kitchen, a new addition to the back of the house. By the way, the tax code does not specify what is substantial improvement. No, it's not going to be that specific because there's too many what if scenarios. This is something, in my opinion, one change in the tax code starting 1/1/18 that did not get that much mileage, if you will. What do you mean by mileage? Well, it didn't get that much mileage. It didn't get that much in the press. For years and years and years, decades, We used to say, well, let's sign you up for this home equity, the second on your home, a second mortgage, collateral with that, and we'll mail you a book of checks, and it's real simple and flexibility. And oh, by the way, at the end of the conversation, oh, by the way, for most people, the interest is tax deductible. And you can use the line to send the kids to college, go on a cruise, or to put a new kitchen in. Today, it's just the opposite. If you deal with home equity lines of credit, in my personal biased opinion, I recommend strongly, you say, well, it's flexible, but when it comes to tax deductibility, in most situations, it's not deductible. Okay, let's just do a class shout out. Yes or no? Yes or no? Does your bank do a lot of volume in home equity lines, home equity loans? Some banks do a lot, some community banks do a lot, some community banks don't do. And that's where I did a lot in one of my 2 community banks. Just happened to be that we had the product and we pushed it heavy. Even though I was a commercial lender, we pushed this, even to our commercial borrowers. Yes or no, does your bank do a lot of home equity loans and lines?
Yes.
Yes.
No.
Yeah.
No.
No.
Okay. Some yeses, some nos. Jeff says yes. Bob says no. Alexis says yes. Okay, good. All right. Thank you. Let's move forward. Page number 15. Still on residential, but we're starting on this page, shifting to more commercial or business. Pardon me. Vacation home. Okay. Vacation home. You have a customer who owns a home. Their primary residence is a block from a major football stadium, college football stadium. Whoa. You know, about 7 or 8 times during the fall, home games, you're going to have a ton of people walking down the street right in front of your home. What do? You lease out your front yard for the tailgate party. It's no more than a block, a half a block, or a block. Let's say it's even just a block or even a half a mile from the football stadium. You're going to have that booked up the entire fall, maybe by the same group. As part of the deal, you even bring in a couple of porta potties. Seriously, you don't want them in your house, but you got a big, nice, beautiful front yard. And they clean up. You've been doing this for years with the same group. How much do you charge for every tailgate party? And that's on a Saturday, depending on when the game is. If it's an afternoon game or an evening game, depending on the timing, it's typically on a Saturday. Saptarshi, how much would you charge if you were the homeowner just to use the front yard? And it's a big front yard, and they put all their barbecues and all their lawn chairs and all of it. And you even let them leave it there. You even let them leave the stuff there, and then after the game, or they have an arrangement, they come and pick up their stuff and they're gone. How much would you charge for each tailgate party, for each game?
I don't know, like $200 to $300 maybe.
$200-300? Okay. Dwight, how much would you charge? And they can have up to, your front yard will accommodate, easily, because it's a big front yard, easily 30 people. How much would you charge Dwight if you were the homeowner?
I'd say $5 a spot.
Okay, $5. So 30. Okay, 150. Mo, how much would you charge?
I'd probably charge a little more, maybe like 10.
Okay. Oh, I charge a lot more. I charge $500 at least for the whole thing, maybe even more. Just go around. Hey, I need my 500. Whether it's cash, whether it's a check, whether it is Venmo, doesn't matter what it is. It is tax-free forever. Look at this. This is legitimate strategy. Look at this. Okay. Look at that. Up to 15 days. Absolutely.
What about liability?
Well, Well, they check their liability policy, and as long as it's not too out of hand, they feel comfortable. They've even contacted their insurance agent. Oh yeah. He says, oh no, we're fine. As long as you keep it no less than or no more than 30 people, 20, 25 maybe, you may be fine. That may be an issue though. That's a good point. Okay. By the way, we have another family member. They live in an area where there was the Olympics years ago. And it was a brother of mine. He says, oh, our entire neighborhood is leaving for the next 2 weeks. Leaving where? Leaving their homes. Where are they going? Oh, they're going to Disneyland, going to Disney World. They're going on cruises. What are you talking about? He says, literally the entire neighborhood is leaving. Why? Well, I knew the Olympics were coming to their town. And I said, wait a minute. And I knew this rule. I said, let me guess. They're doing short-term lease, less than 15 days, which the Olympics last about 2 weeks. And they're going to lease those houses out to the press, the international press, and people from all over the world. And they're going to take that money and go on a cruise or go to Disneyland, go to Disney World, and just be gone for at least 10 days to 2 weeks. And when they come back, they're actually going to have still a little money in their pocket. He goes, absolutely. He laughed. He goes, absolutely. Never taxed. Never taxed. Moving right along. Look at the home office. Okay, here we go. Andrew, do you have any commercial borrowers that operate out of their home office?
Just a few.
Okay, thank you. Charisma, how about you? Do you have any that operate out of their home? Any commercial borrowers? Okay. Well, it used to be, you can see the detailed, it used to be that they would have to fill out the form. It was a detailed form to take the home write-off or the home office write-off. And they would have to break out, okay, the office is certain percentage of square feet versus the entire house and and all the utilities are prorated. At least an hour to do it, maybe even more. Today, simplified version, $5 a square, up to 300 square feet, which is typically the size of most home offices. It's a bedroom or a den. Takes about 2 seconds to complete versus over an hour, hour and a half, if you will. Legitimate, completely legitimate. Moving right along, let's turn to page number 16. Now we're going to shift into commercial, pure commercial real estate. Okay. Look down under number 3. We talked about this yesterday. For those that were with us yesterday, we talked about, oh, wait a minute. Jane approaches you and says, hey, Bob and Sue and I met yesterday, and we'd like to take a couple $100,000 out of the building. She knows, she's already done the calculation. They're down to about 72% loan to value. She knows, because she's discussed this with you in the past, that typically your bank is at 80% max loan to value, typical. She doesn't know it's called a cash out refi, but you do. So you say, well, we call that a cash out refi. As long as the purpose of the 200 is legitimate, well, we're interested. She says, well, it's going to go right back into the building. The roof needs to be repaired, and then she says, well, it's actually going to be replaced. Well, you do the cash out refi. You give them the 200,000. They repair the roof, maybe some other repairs to the building. But when George, the CPA, from a strategy standpoint, is notified, because Jane keeps him informed, hey, we're going to do this, we're going to take 200 out of the building. We're going to repair the roof. Just be aware of it for the next, for the strategy for the next tax return, of course. And Jane actually meets with George. And George says, well, we could either count it as a repair or an improvement. What's the benefit of the repair? I put right below the word repair or repairs, immediate tax write-off. Immediate tax write-off. What about improvement? Improvement, oh, no. That 200,000 goes into the basis of the building and is ultimately depreciated over a long 39 years. Wow. George looks at Jane and says, well, it's 200. I think we could justify it's a repair. She says, well, technically it's a brand new roof for the whole building. Well, we're going to count it as a repair. Immediate write-off. That is a huge benefit, but it depends on the CPA. I would put this in your notes somewhere off to the side of number 3 there. It just depends. Depends on who their CPA is. How aggressive is their CPA? Some CPAs are very aggressive. Some are not. Every answer is, no, it's an improvement. It's the most conservative approach on every tax situation. And some CPAs are kind of in the middle. Sometimes some CPAs are quite conservative, and then they'll shock you from time to time. I work with those types right now. It's like, what? You just assume, quote unquote, assume that they're always going to take the conservative or the hard approach. And all of a sudden they surprise you. It's kind of interesting. Any questions on that? Catherine Lee, any questions on number 3 from a strategy standpoint?
Nope, no questions.
Got it. Thank you. Joey, Merlino, any questions on number 3?
No questions.
Got it. Okay, now cost segregation study. Now, what is a cost segregation study? Now, Bob and Sue, they're with you and they say, boy, okay, you financed the purchase of our building, let's say 9 months ago. And then all of a sudden they realize, wait a minute. They say, boy, we just met with George and Jane, our CFO, and George, and it's just Bob and Sue with you, not Jane, not George, but we just met with both Jane and George, and George informed us 39-year depreciation on that building. Wow. And they look at you and they say, well, we know you're not our tax advisor and so forth. Do you have any ideas somehow to lower that? And you say, well, and pat answer. Well, some of our clients, you're not giving tax advice, but some of our clients have done what's called a cost segregation study. Well, they look at you like, what's that? And you got to be careful. I beg of each of you, you've got to be careful because you don't want to alienate George, the CPA, in the equation, of course, in the relationship. But sometimes if the Georges of the world are not up to speed, they may not realize there are some simple, basic, tried and true tax strategies that relate to the building, which is number 5, cost segregation study. So you got to be careful, but but also add value to yourself and your bank. And they said, well, what's that? Sue blurts out, well, what's that? And you explain, well, George, your CPA would hire, which ultimately means you hire a PE. Everybody, I'd put in your notes a PE at the bottom of this page. PE stands for professional engineer. The professional engineer goes out to the building and she reviews, she walks the building. Now, remember, they already bought the building. You financed it 9 months before, but now all of a sudden the tax issue is going to hit them. They realize 39 years, they're going, no. The PE goes out and she looks at the building and she walks it, and then she comes and she does all of this cost breakdown, or separates the cost into personal property versus real property. Primarily the personal property is a much quicker depreciation than the real property is the 39 years. So it becomes kind of a misnomer that it's all at 39 years. But unless your client does something or their CPA does something, they're stuck. It's going to be 39 years, long drawn out. For example, personal property, the carpet, that's not real property. And she says, well, that's only going to last 5 or 7 years. The electrical conduit in the ceiling, oh, that's only going to last maybe 15, 20 years. The restroom fixtures in the bed in the building, the restroom fixtures in the building may last 15, 18 years, 18 years at the most, something. She redoes all of the cost breakdown, hands the report to George. George is able to take that report and easily justify taking the 39 years that we talked about back on Form 4562 down to what I mentioned earlier. And please put this in your notes on this section, 20 or 21 year depreciation. Absolutely. That is a huge, now it's the same amount of depreciation, but it's crammed into half the time. So it's accelerated by double. Evan, that is a huge tax benefit. Would you agree?
Yes, I agree.
Okay. Wow. Now, how much do these studies cost? Well, depends on the market. Could be, it depends on the area, depends on the size and scope of the building and so forth. It could be $2,500, $3,500, what have you. Who pays for it? Of course, ABC LLC does, or Bob and Sue, the ABC LLC. The CPA just engages, if you will, the PE, the professional engineer. He or she gets that professional engineer, they set it up, if you will. Okay, now, with this strategy, I emphasize, this is a legitimate strategy, long-term, multiple decades. I was training a group of CPAs within about a year and a half ago, just before the pandemic. So it was a ground-based just before the pandemic. And I mentioned 20 or 21 years. A lady in the back of the room, CPA attendee, she blurted out, I've been able to figure out how to get it down to as low as 17 or 18 years with my clients. Everyone turns around like, whoa, like, how are you doing that? Seriously, wow. Moving right along. Page number 17, further in the commercial real estate still, 1031 tax-free exchange. Okay, I need to ask straight out before we get into this one. We review this strategy. Let's do a quick class shout out. Everybody in the audio, everybody in the chat, or if you're in the chat, yes or no, have you ever dealt with a 1031 tax-free exchange? Have you ever dealt with one of these? Yes or no?
No.
Yes.
No.
Yes.
No.
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 More
Yes.
no's, a couple of yeses. Okay. Jeff says yes. Jeff says yes. Bob says no. Okay. All right. And a few in the audio as well. Well, what is it? Well, okay. And by the way, here's another one. This is a classic tax strategy, pardon me, that has been around for multiple decades going back. So this is, none of these, as I mentioned at the very start of our session today, none of these strategies are kind of wacky or, like fringe type tax ploys or whatever. No way. This is what happens. Bob and Sue, they say, well, we're going to sell our building. We're going to go buy a new building. And they say, wait a minute. We may suffer a pretty good tax hit. We got quite a, we did the numbers, or Jane, the CFO's prepared the numbers, the initial. She may have even talked to George, the CPA. And they say, wait a minute, isn't there some way to not pay this, to defer this payment on the building? It's a sizable amount. And they're just chit-chatting with you over lunch or wherever. And you say, well, some of our clients have done a 1031 tax-free exchange. And Bob blurts out, yeah, I've heard of that. Sue says, yeah, we saw something on that, but what is that? Can you explain that? And then you explain it. You say, well, it's basically deferring the gain from building 1 to building 2 to the next building. And the rules are under Part B, 1B, you have 45 days from the close of the sale of the first building to identify the second building. So right below the 45 days, I would put identify. 45 days from the close of the first building to identify the second building. You have, Bob and Sue, you have 6 months from the close of the first building, building 1, to close on building 2. Otherwise, you blow the exchange and you basically pay tax like you would have anyway on the first building. They say, hey, we're going to look into this. Of course, they have Jane work on it even more, and they even approach George, and they do it. What is the huge benefit? They do this 2 or 3 or 4 times over the next 20 years. Then they sell the last building. Now they pay a good chunk of tax, but in theory, by that time they're retired. They're in a much lower tax bracket. Number one. Number two, they've got a good chunk of equity in that last building, of course, because they haven't paid tax as they've gone. They've deferred it, deferred. Look at the 1035 down below. Tax-free exchange. This is on an insurance policy. Insurance policy. Okay. You have 3 insurance policies, Bob and Sue do, and they combine them. They have cash value life insurance, CVLI, and all 3 of them. There could be a tax consequence unless the insurance companies will give up the policy and the CVLI to the other insurance company the right way as a 1035 tax-free exchange. Just another part of the tax code, 1031 versus 1035. Okay, not to be personal. We did the 1035. My wife and I did that on myself. Oh, 6-7 years ago. Combined 3 policies in one. No tax. Going back up to the 1031. Not to be personal, I have physically never done one, but I came close. Not to be personal, my wife and I had a rental house. This is several years ago. We sold the rental house. $100,000 gain on the rental house. Man, capital gain. Whoa. I thought, man, I don't want to pay that. I'm an American, right? Right, Catherine Walker? I'm an American. I don't want to pay that tax. Let someone else pay it. Right, Catherine? Is that how it is in America? Is that what the average American thinks?
Pretty much. Just what? Death and taxes?
I love it. That's great. That's the only 2 things you can count on. Well, so I told my wife, I said, let's do this 1031. And so we took the $100,000 gain. This is personal, and I don't mind sharing this, and put it into what's called an exchange company. Okay. Now that's a fancy way of saying this company does these 1031s all day long. And then the people, and of course they do it for a fee. And of course they put these deposits or these monies as a deposit in the community bank. Okay. Or in the bank. So the banks love it because those monies sit there for several months, not even touched until the exchange is done. Well, we are out looking for another property to roll the gain into. 45 days, 6 days, the 2 rules of thumb. Well, about 2 weeks into the deal, and by the way, not just exchange companies do this, but most all title companies will do this as well. All over America, it's common. That's how common it is. Well, and this exchange company, boy, they were the up and coming in the Vegas market, and all these huge developers had millions of dollars into this exchange company, and there were 2 community banks that grabbed all the deposits. Oh yeah, they fought for them, and now the exchange company gave half to one, half to this other community bank. Everyone's happy. Everybody's making money. Back to our situation. 2 weeks after putting the money in, we're still looking for another property. Something told me, get the money out, get the money out. I said to my wife, I'm going to get the money out. She goes, okay. So I called the company, went down, got a cashier's check. They're all excited, like, why are you taking the money out? You're not going to do the exchange. I said, no, we just decided to pay the tax, which we did. Put the $100,000 in the bank, paid the tax. less than 2 weeks after the 2 weeks, meaning 2 weeks in, another 2 weeks went by after I took the money out. All of a sudden, all over the local news channels and in the local paper and in the local business community, it hits the fan. This exchange company is broke. The two founders have left town with millions in their pockets, and the FBI cannot find those two people. And the exchange company goes BK, and millions of dollars are lost in this fiasco. And to boot, the two community banks that held the deposits, they got in the middle of the mess. It was so bad, both of the community banks almost went under. Literally, were almost shut down. FDIC almost, both of them came within just a hair of being shut down by the FDIC. Seriously, and just boom, the feds. Because it was all embroiled in this entire mess. And the two founders, FBI could never find them. And they took off with millions of dollars. True story. True story. We're watching the news, my wife and I, and it comes on the news. I already knew what would happen because I told her, but she didn't connect the dots. But when she saw it on the news and saw the whole story, she's my wife, not to be personal, she is tripping out. She goes, wait a minute, is our money in there? I said, no, remember I got it out 2 weeks ago. No, our money's there. No, it's out 2 weeks ago. No. I said, no, it's in the bank, in our bank, not in those two community banks, those other community banks. It was in our community bank, not those two others. She goes, oh man, wow. Moving right along. Most title companies, Fatco, First American Title, and the major one, Chicago Title, those, it's not an issue. But this was and there's nothing wrong with being a local title company. But this was a classic where everybody is excited. All the developer money's in there. The two community banks are making money hand over fist, and then all of a sudden, the two main players leaving Las Vegas with millions in their pockets. Moving right along. Turn to page number 18. Here we go. We're going to shift, but before we shift into, we're going to shift into employer benefit, retirement, and the HSA. And then we're going to retirement strategy. Let's go ahead. We're going to take our first 5-minute break in the afternoon break. Before we do so, are there any questions? Joey Holman, any questions? Any questions?
Nope, no questions.
Got it. Graham, any questions for us? Any questions before we take our break?
I'm all set.
Got it. Thank you. Talk to you in 5 minutes, everyone. Thank you.
Okay, I think we're back. Oh, I think we might be on a break. You want to just do it at our desk because yeah.
Welcome back, everyone. We'll go ahead and continue in just a moment. Okay, Jack, are you with us? Can you do the sound check, please?
Oh, sorry. Yep, I can hear you.
Great. Thank you, Jack. Thank you. Appreciate that. Now let's move forward. 2 benefits to you as an employee in the bank. Now this is going to lead us into heavy retirement strategy for the small to medium-sized business owners. Ties into the business, ties into their personal. We have the defined benefit plan. You can see down, or pardon me, defined contribution plan under number 1 down below 401k. Okay, let's do a quick class shout out. How many of us are in a 401k? Right? Yes or no, everybody. How many of us are in a 401k?
Yes.
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 Okay. Bob is, most of us are. Excellent. Okay, good. Now, but you have to contribute. And then of course the bank contributes a portion or whatever. A DB plan or defined benefit plan down below under number 2 is an old-fashioned retirement plan. There's not many of them. They're an old-fashioned pension plan. There's not many. A PERS stands for Public Employee Retirement System. In the state of Wisconsin, you have a school teacher. In the state of Michigan, you have a firefighter. Boy, they're in a PERS. They don't put money in. Now, they often have what is called a 403B or even a 457, which is kind of like a 401k, but oftentimes the employer does not put money in. Why? They don't match. Why? Because they're getting a basically a free defined benefit plan on the other hand, under number 2. So we have a family member who works for the county. Well, He has a defined benefit plan, a PERS plan that he will get when he retires. And he has a 403B. Once again, his money that goes in the 403B is tax shelter. That's pre-tax dollars, but there's no matching because he gets the full benefit on the other, on part 2. Page number 19 now. The other side of your benefit as an employee of the bank. Some of you are in a health savings plan or a HSA for short. Let's do a quick class out on this one. Yes or no? Are you in or do you have an HSA provided for your benefit? Yes or no? Everybody in the class.
Yes.
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 Okay, quite a few. Bob says no. Jeff says yes. Okay. Justin says yes, so forth. Okay, good. All right. Now, some of your banks even provide HSAs to the public, meaning like it's a product, like a bank CD, certificate of deposit's a product, or an IRA is a product. Next time you have a customer say, well, what's the tax benefit of an HSA? Like a Bob and Sue, for their small business. Let's say they're the small manufacturer back in Grand Rapids. Oh, they have 30, 35 employees at the max. What's the benefit? Triple. Pre-tax dollars go in. The dollars go in pre-taxed, pardon me, similar to a traditional IRA. Under number 2, it grows tax deferred, just like a traditional IRA. But this is the part that differs. When you turn 65 years old, your old 401k, and you go to retire, and you go on to Medicare at 65. Look under number 3. Your HSA will automatically convert to a traditional IRA. Traditional IRA. And if the money is taken out for medical purposes, it's never taxed. What? When you have a traditional IRA, it's pre-taxed. It grows tax deferred. And when you take out the money after you go to retire, say you're 65 or whatever, it doesn't matter if it's for medical, doesn't matter if it's for a cruise, doesn't matter if it's to buy a new automobile, it doesn't matter. You pull a penny out of that plan, you get taxed on it. But not an old HSA that's converted to an IRA as long as it's taken out for medical purposes. What do you mean by medical? Well, you're now in your 60s, late 60s. All your pharmaceuticals, all your meds, those are, you take them, you go into retirement at age 65 and you still have $35,000 in that old HSA. It would behoove you to keep that HSA from a strategy standpoint and use those dollars for the rest of your life for your medical support. How about the premiums on Medicare? Even though Medicare is provided, usually you have like plan A, plan B, whatever. There's a supplementary, it's, $300 a month or $200 a month, whatever. Take it right out of the HSA that's now an IRA. Never taxed. Fast forward, Mickey, you're 65 when this is put in place. 65 years old, Mickey. But Mickey, when you turn 90, 25 years later, you qualify for what? The scooter chair. I'm just making that up. I'm being facetious. Mickey, how much does a scooter chair cost, would you guess, today? Just throw out a number. What do you think it would cost?
$1,500.
$1,500? No, those are like 8 or 10,000. Those scooter chairs? Oh yeah, 8 or 10,000. Where do you take the money out of? Your old HSA, tax-free forever. It was never taxed on the front end. It grew tax deferred. And by the way, that 35,000, as it grows, it just grows tax deferred. It's still in that same plan. And when you take out the money for that scooter chair, Mickey, is medical purposes. You're 90 years old. It's never taxed ever on the back end. What do we call this in tax strategy? This is called America. This is called America. I'm just kidding. Moving right along. Here we do. Some people do. I call it America. The tax code is America. Let's turn down to page number 20. Retirement planning. IRAs, SEPs, K accounts, individual. What's a carve out? What is a carve out? Okay, we need volunteer. Anyone in our class, have you ever heard of a carve out? Have you ever heard of a carve out when it comes to retirement planning? Anyone? Anyone? Okay. Years ago, we used to have a lot of carve out plans for business owners like Bob and Sue. The carve out means it's a slang way of saying they have those 30 or 35 employees in the manufacturing firm. Well, the carve out would allow Bob and Sue to basically take almost all the retirement dollars from the company to themselves and leave, quote unquote, the crumbs for the employees. Well, over time, the laws have changed. The carve out plans, they're not completely dead, but for the most part, they are. There are a few still out there, but they used to be real prevalent in the past. We're going to see a change to the tax code just in the last year or so, year and a half, that happened right before the pandemic hit, that promotes even more retirement planning. We'll see that in just a moment in exhibit number 3. Moving right along. Further in retirement, now page number 21. Pardon me. Back to the DB plan. I'd highlight this on page 21. I mentioned the DB plan, defined benefit plan, like a school teacher, like a firefighter, like a police officer, whatever. Well, you can see on the top of this page, General Motors, GM, or United Airlines. They had old-fashioned pension plans, but they were considered, the slang term is top heavy, meaning there were too many benefits for too many employees, or too few benefits for too many employees, and those plans basically imploded. They had to go to there's a special court system for retirement plans or pension plans. And they had to go there and say, Your Honor, we're United Airlines. We've been paying our, a retired captain, airline captain, $10,000 a month in retirement. And we just don't have the money. The fund doesn't have the money. What have you. And they were able to get the courts to lower that from $10,000 a month down to $5,000. Wow. Literally. Well, in 2001, someone looked in the tax code and says, we can use the same part of the tax code that these big, huge corporations for multiple decades have had, these big retirement plans that are now top heavy, and a lot of these are imploding. But we could use this for a self-employed professional. Now look at part number 2. You see, instead of using what in the tax code right now, a 401k is limited right now in 21, is limited to $19,500 a year, contribution limit. But if the individual is 50 and above, it's called the catch-up provision, or it's $6,500 for a total of $26,000. I'd put that in your notes, please. 19.5 is the max, but if you're age 50 and above, it's another $6,500 catch-up provision for a total of 26. What do you mean catch-up? What are they catching up for? Retirement. Okay, they have to be 50 and above. Okay, now that's 26,000. We're going to see in exhibit 3 in just a moment where even the self-employed may be able to go up to as high as 64,500. 64,500 in a 401k contribution. But look at number 2. Look at the number off to the right. A DB plan for a self-employed individual, professional usually, they can contribute as much as $200 to $250,000 annually. You're thinking, no way. Oh yeah, this isn't real. Oh, it is. This, I emphasize, this is as real as it comes. You're going like, what? Let's illustrate. Right below the 200 to 250. Now remember, versus 26,000 if the person's 50 and above, or self-employed 401k if they're 50 and above, 64,500 in this year, right now in 21. Well, wait a minute, how do they do this? Well, this is based off the other part of the tax code, not the 401k. This is based off of the tax code dealing with the DB or defined benefit plan. Okay, let's say Beth is a top architect in Milwaukee. She is top of the line. She is very well respected in the local market. Right below the 200, 250 in that little blank spot, if you would please put $400,000. That's what she grosses. She's a top architect in the entire Milwaukee market. $400,000 a year. Well, she has no employees. She has no employees. Okay. Now, she has roughly 6, 7 independent contractors. They're not employees. Boy, she's crossed the T's, dotted the I's, because there's certain requirements. Are they really an employee, kind of a quasi-employee, and you're just calling them independent? No, these are really independent contractors. She pays them approximately $100,000 for the overhead of the business. If you put $400,000 right below that, please, $100,000 overhead for the 6 employees. They do a lot of the work. Of course, she works, but she dishes out, and they're doing all the work, and it funnels up through her firm. Legitimate. Those are true independent contractors. Okay. There's another 100,000. So it goes 400 minus the overhead of 100, minus 100 that she needs to live on, her living. That leaves 200,000. Okay, mathematically 200,000. If she does not do something, the world of tax will annihilate her. It will eat her alive. So she goes to her tax advisor. What do I do? Let's set up a DB plan. What do you mean? Well, let's set up the DB plan. She could put $200,000 into the DB plan. Now it's based upon her actuarial life. So if she's a little older, if she's above 50, it's even better because she has less years to work before she goes to retire. So the plan allows her to put in 200,000. I have CFO clients right now that put 200, 250 in these plans year in and year out. You're saying, well, where'd you get the money? Well, the 400, she grosses 400. Absolutely. Top architect with 6 workers that are non-employees. Because if they were employees, she'd have to share. She'd have to give them a piece of this plan, which she could do, but it's cleaner. They'd rather be self-employed. Why? Because they can do their own DB plans or whatever plans they have. She puts 200,000 in. It comes down to the basic decision. Do I pay myself or do I pay Uncle Sam? That's really what it boils down to. Okay, now, on a practical basis, who does she do to set up a DB plan? You won't believe this. She goes, okay, everybody blurted out you have a 401k. Every one of your banks works with what's called a TPA, third party administrator. Okay, TPA for short. She goes to the TPA. It's the same company. They can set up a 401k, they can set up a DB plan, they can set up, they do it all. How much does this plan cost to start? Oh, $1,000 to $1,500. How much does this plan cost to maintain annually? Oh, $1,000, $750 to $1,000. You may think, well, that's a little pricey, but not. When you look at the perspective of the dollars that she's saving on the tax, that's nothing. Now it gets even better. Look at number 3. Look at the strategies for the investments. Real estate, commercial, residential, rental, land. Now they can't put their own home in it, of course, but they can put a rental house or a building, stocks, bonds. Look at precious metals. No ownership in an operating business, but they can lend to an operating business. This is huge. This is huge. You may even have clients you don't even realize they're in a DB plan right now. Just a thought. This works really well strategy-wise for the self-employed professional like Beth, the architect. Moving right along. Any questions on this one? Dylan, any questions? Go ahead.
Hey, it's Dwight and Mo. I haven't
Yes.
had a lead. We're having a lot of connection problems. I've had to reconnect twice in the last 20 minutes. So we're going to disconnect just for the end of this and watch the rest lot.
Okay. Thank you for that. I apologize. I know yesterday you had the same, you bet.
Yeah,
Now,
this room that we use for stuff like this just doesn't have great connection to the Wi-Fi.
Oh,
It has
okay.
internet access, but
Got it. Thank you for letting me
very
know.
much.
You bet. Is Evan going to be gone too or not? Is
Yeah,
he gonna
Evan will be gone as well.
Also,
yeah.
okay.
Yep.
Thank you, gentlemen. Thank you for
Thank you.
for
Take care.
attending. You bet. Take it easy. Okay, now moving right along. Any questions on the DB plan? Any questions? Heather, any questions on this?
No.
Okay. Matthew, any questions on this strategy?
No, makes sense here.
You bet. Let's move forward. Let's turn to page 22. Further, now we're going to go from retirement planning to estate planning. It's related, but technically a little different. So we're going from retirement into estate planning. Look at part A. This was a real popular strategy until the TCJA kicked in, Tax Cuts and Jobs Act, starting 1/1 of 18. It's called generation skipping. Grandma and grandpa are in their 50s. Their adult kids are in their 30s, and they have grandkids that are 8, 9, and 10 years old, 3 of them. Grandma and grandpa have an LLC, and it has $10 million in commercial real estate in it. Well, if they do nothing, when they pass, the children will inherit the $10 million. And the kids will pay up to 40% in inheritance tax. Wow. Well, this was an old strategy, but it's a recent old strategy. That's why I kept it in here. The grandparents give the 3 grandchildren. You have to skip the children that are in their late 30s, the grandkids, mid to late 30s. The grandkids are 8, 9, and 10. They give each of those little kids 2% ownership of their LLC. They own 94%. They control it, of course. The grandkids have 2% apiece. Fast forward 30 years. The grandparents are now in their 80s and they both pass. Grandma and grandpa pass. The grandchildren are now 38, 39, and 40 years old. Okay. Who now owns the LLC? And it's not 10 million. Now it's up to $15 million in real estate. The grandchildren do. Now, because it's a family-owned business or investment, the adult children that are now in their 50s, they say, they basically control it. But on paper, the 3 grandchildren now own the 10 million. That's now $15 million in commercial real estate. And the entire family, extended family, has avoided 40% tax on that inheritance. Now, why did this go away? Because as we're going to see in just a moment, the TCJA, the Tax Cuts and Jobs Act, doubled the inheritance tax exemption. So now most of your clients, they don't have to do this strategy part A. because the exemption amount has been doubled from approximately 5.5 million to 11.7 million per person. So Bob and Sue, 11.7, 11.7 times 2, that's over $23 million. So if the estate's less than 23 million, which probably most of your clients are, don't even have to mess around with Part A. What about Part B? You used to be able to, up until just a year and a half ago, when you inherited an IRA, you could stretch it out to 2 generations. You inherited, that's the first from your grandmother, your parent. Pardon me, you keep it until you pass, that's 2 generations. And then the tax is due. That's gone away because of the Secure Act. We'll see in just a moment. Under Part C, cash value life insurance, there are multiple strategies, if you will, related to CVLI and lending against it and so forth. I deal with a financial planner here in Las Vegas, for whatever it's worth. He does these loans against the cash value. The insurance company does, and his clients take the loan against their own cash value. And then what are they doing with the cash? They are buying residential real estate rentals in the Midwest, because the Midwest, the housing is much cheaper than a place called Vegas or California or other parts of the country. Let's go down to Part D, a CRUT. Now, some of you bank the farmers. Some of your banks bank the farmers. A CRUT is a huge, huge benefit for the farm family, tax-wise. Okay. Let's set up the scenario under Part D. And I take a few notes at the bottom of this page, Part D, especially if you do ag lending or lend to the farmers. Absolutely. Bob and Sue, they're not a manufacturer, ABC LLC. They're not a commercial real estate developer. We're going to shift them a third time. They are now a farm operation in the UP. Okay. Just, they're not that far from Escanaba. They're maybe a half hour north of Escanaba. Okay. Farm operation. Now, they go, and let's say, just to keep the math real simple, the farm is worth $1 million. Okay. They go to retire, but their children, their grandchildren, none of them want to run the farm. No way. No, that's old fashioned. I'm not going to get up at 4 a.m, da. Okay. So they don't know what to do. And all of a sudden they get their magazine from their alma mater, from their alumni magazine. They were both agribusiness majors, Bob and Sue. Okay. Where? Michigan State. Okay. In East Lansing. Now, big ad in the thing. If you have, properties, including farms, donate to the Michigan State University Foundation, not the university, but the foundation. They look at each other and say, why don't we do it? The kids, the grandkids, they don't want the farm. They donate that farm worth $1 million. D1, right next to D1, I'd put in your notes. The first year they get anywhere from a 10% to 40% tax write-off, which is 100 to 400,000, somewhere in the range. The very first year right out of the chute. Wow, that's huge. 10 to 40% write-off of the amount of the donated farm, which is 100 to 400,000. Number 2, they get an annuity. Now it's annual, but it's broken up into monthly check. They get a monthly check off this deal. From whom? The foundation. Well, what does the foundation do? They take the farm, they sell it, and they invest the money, and then they're giving them a check every month. When Bob and Sue pass under number 3, the check stops. It's done. The deal's done. And the asset officially is no longer in their estate for estate planning purposes, which is a good thing. It's going to help their children, their grandchildren out. because it passes to the charity, which is Michigan State University Foundation. Questions on the CRUT? James, any questions on this strategy under Part D?
Nope.
Got it. Lonzo, any questions or comments under Part D?
Nope, nothing here.
Got it. Thank you. Moving right along. Let's turn to page 23. Pardon me. Further in the estate planning. Now, Bob and Sue can contribute up to $100,000 annually tax-free from a distribution, meaning, pardon me, from taking the distribution. They don't really take the distribution. They give the distribution to the charity. Okay. That's another estate plan tool. Look at Part F. They can gift up to $15,000 per person per year in this year, 21. It doesn't even have to be a family member. They can just gift it, to a friend, a family member, their granddaughter. Let's gift her $15,000. She's going to college now. She's going to our alma mater, Michigan State, or University of Michigan, or University of Wisconsin-Madison, or wherever. Wow. No impact on the inheritance tax exemption. Look at Part G. Inheritance tax exemption. I mentioned just a moment ago. Before the TCJA, it was approximately just a little below 5.5 million. And then it essentially doubled up to 11 million. And then since 2018, 19, 20, 21, it's now up to 11,700,000 per person. You double that, you're talking over 23 million. They could have an estate of 20 million down below. No inheritance tax. Remember, traditionally in America, inheritance tax is upwards of 40%. Whoa. By the way, the exemption goes away in 25. If 2025, if Congress does nothing, meaning there is no tax. There's no tax, inheritance tax. By the way, many of the provisions of the TCJA, Tax Cuts and Jobs Act, they're scheduled to go away in the next couple of years from now if Congress doesn't act. There is a lot, in my personal opinion, that is going to be happening over the next 2 years when it comes to the tax code of America. Oh, absolutely. Based on the US Congress. We'll talk about that further in just a moment in Exhibit 3. Let's turn forward to page number 24. Year-end tax strategy. Run a car through the business that we use the car in the business. We forgot to run it through the business. Retirement planning. We covered many different plans. Here's another one. Add a spouse to the payroll. What I'd like everyone to do, spend just a minute or two on this. What would be another year-end tax strategy that Bob and Sue could utilize? Just another one you can think of. Just a tax strategy based off of the year end to benefit them. Take just a moment. Everyone, think about this. I'm going to ask a couple of you your ideas. Now I gave you some. There's some up above. They run a car through the business they haven't done. They increase or they change their retirement planning. Add a spouse to the payroll. But there's others. Take just a moment more. We'll come back together. Just think about, are there any year-end strategies you can think of? Maybe some of your clients have done. Maybe a family member has done. Just a thought. Take just another moment. Okay, here we go. Alexa, can you type into the chat? Can you think of any? And while we wait on that, if you can think of a year-end tax strategy, while we wait on that, Jordan, can you think of one? Can you think of a tax strategy? Maybe a client has used, maybe even a family member that owns a business, whatever. Jordan, can you think of a tax strategy year-end? Okay. Septarshi, how about you? Can you think of a tax strategy, another one year-end?
maybe give your spouse 1% ownership in the LLC.
Oh, I love
Yeah,
it.
I don't get too much.
Yes, that's good. A shadow owner. Get out of the crosshairs of the Schedule C. Good. Andrew, any others that you can think of? Andrew? Andrew's
At
year-end
the end
tax.
of the year, probably
End of the
not.
year.
But if they had enough foresight and enough luck, you could have a baby.
Oh, that's good. Oh, I love it. That's the child tax credit. We're going to see that 0 to 5 years of age, or up to 6. Well, you're 5 is 3,600. Absolutely. We're going to see that in just a moment. Charisma, any other thoughts? Year-end tax strategies.
To build on the car example, I know a family member that bought a side-by-side with a plow to plow their business.
Oh, I love it. But it's really a side by side. Oh, that's
But it's
good.
side by side. But it has, I mean,
Oh.
they use it for what it's intended, but in the summer they use it
Just-
for not its intention.
Oh, I love that. That's great. Catherine, any other thoughts? Catherine Lee, any other thoughts?
I've seen some people come in and put money into either an IRA or their health savings account at the end of the year before their taxes are filed.
That is legitimate. That is good. Joey Merlino, what, any others you can think of? Joey?
Yeah, I was just about to mention the retirement or HSA account at the end of the year as well. Just make
Yeah.
sure to max those out.
Good, good. Bob and Jeff, any other comments in the chat you can think of? And while we wait on that, Catherine Walker, any other thoughts for year-end strategy?
Yeah, what about charitable donations?
Oh, absolutely. You've got not just the example of the farm with the crud, that's a big transaction, multi-year and all that, but even a smaller, sell some stock, do whatever. Absolutely. That's good. Okay, let's see. Bob says, take a loss on a stock portfolio. There it is, on a stock portfolio for those certain loser stocks. Good. Excellent, Bob. Bob, you read my mind. That's great. Here's another one for the farm, for the ag lenders in our group today, in our class today. Some farmers they'll buy their seed in the fall, take the write-off. But when do they plant the seed? In the spring. Kind of interesting. Now, one last comment, we move forward. I beg of each of you to consider this. If something from today's session can benefit you, your family, a family member, a friend, without giving tax advice, specific advice, it's tax information, more power to you. In my opinion, boy, that's just a little bit of icing on the cake for attending today's class. Seriously, if any of these concepts benefit you personally, family member, friend, what have you, it's information. It's not like, well, David gave me specific tax advice for my specific. No, it's information, it's knowledge. That's great, in my opinion. Just a thought, just a thought. Moving right along, let's turn forward to page number 25 now. If you'd be so kind, pardon me, let's go ahead. I'm going to stop sharing this. Everybody, if you'll put the main PowerPoint to the side and take out Exhibit 3, our last exhibit. Now, give me just a second. I'm going to pull this up. Give me just a second on this. Okay. Okay, there we go. Now, let me put that up. There we go. Okay. All right. Joey Hallman, can you see that on your screen, Exhibit 3?
Yes, I can.
Excellent. Thank you for doing that. Okay, now we're going to just go into this. This is our third section today, the tax updates. Now, as you can see, we've been doing tax updates all the way throughout the session from the get-go. Let's just start into this for just a moment, then we're going to take our last break of the session. So turn forward to page number 2. Bottom right-hand side of the pages, you'll notice are the page numbers. Pardon me, this is page number 2, bottom right-hand side, and you'll notice we're going to start when we get back from our break. The TCJA, and it's of 17. Now, we said earlier 18, well, it's because It was signed into law in December, end of December of 17, became effective 1/1 of 18. So before we go into this exhibit and go through the updates and all the other changes, including things that are happening right now in America relative to tax and tax strategy, let's take our last 5-minute stretch break and we'll come on back. We'll go ahead and do exhibit 3, and then we're going to do a little summary activity and then get you on your way for the afternoon and evening. Talk to you in 5 minutes, everyone. Thank you. Welcome back, everyone. We'll take just a moment and then we'll conclude our last little section for today's presentation. Okay, Graham, are you back with us? Can you do our sound check, please?
Yep, I can hear you.
Great, thank you for doing that. Okay, let's move forward. Here we go. Now, just to highlight, some of this will go rather quick and others will kind of slow down, but the standard deduction was nearly doubled. I'd highlight that part A here on page number 2. Pardon me, and once again, the page numbers are on the bottom right-hand side of the pages. Part B, I'd highlight personal exemptions eliminated. Okay. Turn to page number 3, please. Remember, we talked about the first 20% of pass-through income tax. We even saw that on the front of the 1040. It's called the QBI, Qualified Business Income. There it is, small business, S Corp, LLC, partnerships, sole proprietorships. Turn forward. Now, if you'll highlight, you can see at the very bottom of this page under Part J, child tax credit. Before the TCJA, it was $1,000 per child. Then it was doubled to $2,000 per child. And we're going to see where it even goes way higher, of course, today. Turn forward to page number 5. This is still in the TCJA. If you look under Part K, I'd put Part K, I'd highlight that. This is, of course, for the Section 179, where it was doubled from $500,000 to $1 million. I'd also highlight Part L. We talked about this, the tax deductibility of a HELOC or a home equity loan repealed, and less dollars are used to make substantial improvement to the house. Also under Part N, just to highlight, to summarize what we've discussed, page number 5 here in Part N, the exemption, $250,000 for a single filer, $500,000 for married filing jointly. And as I mentioned just a moment ago, most of the provisions of the TCJA will expire in just the next few years, somewhere 23, 24, but definitely by 25, unless Congress extends them. Let's move forward, please. Now, look at the date, and I would highlight this. This next several slides are the updates, the most current tax changes beyond the TCJA. So I would highlight, you can see December 20th of 19. Of course, this is pre-COVID. And this, for example, under Part D, I mentioned this, the PMI or private mortgage insurance remains tax deductible. So I'd highlight Part D, just as an example, or part of this particular update. And if you turn to page number 7, we see the Secure Act. The Secure Act was, and if you will highlight this, also December of 19, right before the pandemic, a few months before. The whole spirit of this update to the tax code is to promote more and more or enhanced retirement planning by the average employee in America. Now, the IRA, you can see under Part B, we talked about the 2-generation stretching. They eliminated that as a tax strategy. But under Part C, the required minimum distributions, or RMDs for short, they moved from 70 and a half up to 72 years of age, meaning you go to retire. Let's say you retire at 65. You don't have to take the distributions out of your IRAs. It used to be until you were 70 and a half. Now it's up to 72. Well, where did they get the money to pay for? Under Part B. They eliminated one strategy, expanded the other. Who's they? Well, the US Congress. It's not the IRS. Who makes the tax code? US Congress. Look at Part E. Please, if you will highlight or circle all of Part E. I mentioned this earlier. Part of the Secure Act, or I mentioned there was updates to the tax code, was to promote more and more retirement planning. Well, it used to be that most all part-time employees were blocked out of the 401k. Today, you can see now more and more are able to join to prepare for retirement. Basically, much more of the burden of retirement has been moved from government and business, corporate, to the employee themselves. Of course, you know that. You work, you're an employee, you have a 401k. Absolutely. Moving forward. Now for the CARES Act. Pandemic, COVID related. I'd highlight 327 of 20, please. Signed into law. Okay, we'll take a few of these. This is a major flexibility in the tax code. Some of these things I would have thought, what? I would have never thought we'd ever see. Of course, the pandemic is, we haven't had one of these to this level since 1918, 1919, the Spanish flu. Look at the RMDs, required minimum distribution, suspended for 2020. And we're going to see in a moment, it's fast forward. Most of these provisions are also in 21. So if an individual had to take an RMD, they don't have to. Look at Part D. There's typically a 10% penalty for early withdrawal of an IRA. If you're under 59.5, well, that's been waived. Look at the 401k loan. Wow. Look at the NOL at the very bottom. Net operating loss. We're going to see this in a minute. The rules relative to, remember we talked about that $1 million loss that Bob and that ABC LLC had 5 years ago, and George, the CPA, said, well, let's take 100,000 a year for 10 years. Well, the rules related to NOLs has been relaxed quite a bit because of the CARES Act. Moving right along. Now, the next change to the tax code, if you will highlight December of 20, this is right before the end of the year. And this is a radical. Now, we talked about this yesterday. Andrew, we talked about this yesterday relative to the PPP. Is that correct?
Yes, sir.
You bet. Okay, now, first off, you can see under Part B, it extends most of the provisions of the CARES Act all the way through the end of this year. Number one. Number two, look at Part C. For those that have just joined us today, Andrew brought up the PPP. His bank adds it into the cash flow and so forth. Well, this is unheard of in American tax code, that you could have a forgiven portion of a PPP loan, not taxed. And then look at the next line down under Part C. But the business expenses that are part of the loan, or that were to use to justify the loan, are still tax deductible. This is a double benefit. This is unheard of in America. This is outrageous. Towards the end of 20, I started having conversations with several of my CPA friends and associates. I had a couple of CPAs, one in particular, a friend of mine. I started to see the literature out, various articles saying, boy, Congress may do this, Part C. They may give a double benefit, forgiven on the top end, and you still get to write off the expenses on the bottom end for tax purposes. Unheard of in American history, really, that I've ever heard of or known of. I had one CPA friend of mine adamant, they will never do it. They will never do it. They will never do it. Well, December 27th, they did it, of 20. I called my friend. I said, did you see the news? Yeah, I can't believe they did it. Can't believe they did it. But they did. Kind of interesting. Moving forward. Now for the latest and greatest. This is the most recent. I mentioned this at the very start of the session. This is the most recent update to the tax code in America. I would please highlight or circle March 11th of 21. There is none since then. Not yet. Of course, it's pending in the US Congress, as we talked about. $1.9 trillion package, the ARP plan, American Rescue Plan. Look at the child tax credit, $3,600 per child, under 6, between 6 and 17, 3,000, or $300 a month and $250 a month. Previously, once again, was 1,000, then TCGA went up to 2,000. Now it's as high as 3,600, depending on the age of the child. Okay, now, but everybody at the bottom of this page, page 10, I'd like to have you add this to your notes. Right now in the US Congress, there are two different plans, and it gets a little confusing. One is $1 trillion for infrastructure, and the other one is $3.5 trillion for another plan. I emphasize straight up front, I'm politically neutral. I'm just reporting the facts. How these will pan out, who knows? Most people believe that whatever is panned out, it will be a sizable dollar amount. And I personally believe that. No matter what, it'll be some sort of a pretty sizable. Now, will it be the full million and the trillion, 1 trillion and the 3.5 trillion? Probably not. Okay. Now, how is this going to be paid for? Okay, these are some of the ideals or ideas that have been put out. In no particular order, but if you would add this to your notes, these are just some. And there's even others besides this I've seen, but these are some of the main ones. No particular order. Number one, the corporate tax rate will go to a minimum of 15%. Now, this is primarily the large publicly traded C Corps. It'll be a 15% across the board. Okay, 15%. Number two, we mentioned this earlier when we did the Schedule D cap gains, cap losses, and then later in our strategy section we saw 0, 15, 20, and I mentioned a fourth tier. So I would add capital gains, fourth tier added, which would be 39.6%. 39.6%. Number three, individual tax rate, the max is 37. There would be another tier beyond that, which would be 39.6. 39.6. Number four, the 1031 tax-free exchange program that we just reviewed, and it's been in place for decades, would go away. Gone. No, you cannot defer that tax, Bob and Sue. You sell that building, you will pay the tax. There is no option. You'll pay it now. Number five, the 20% QBI, qualified business income, that we just saw, that passed that tax-free for the small business owner, including Bob and Sue, gone, completely eliminated. Number six, the stepped up basis would go away. Oh, well, what's that? You inherit a commercial building. Okay, let's just use this to keep the numbers simple. It's worth $2 million. You inherit it. Well, Bob and Sue, they're your grandparents, for example. They give it to you. Okay. Their basis in the building is 500,000, just made up the number. But you inherit it's worth 2 million. Well, your basis step up means it's to the current value, it's 2 million. Well, if this would go through, the step up basis would go away. You go to sell that building, you're going to pay gain, you're going to pay tax on the gain from the 500,000 up to the 2 million. Absolutely. Not from the 2 million to the 2 million. If you turn around, you inherit it, and then just turn around and sell it. The basis, the stepped up basis would go away. Wow. Moving right along. And there's others. There's even others. I've saw one, a situation with a financial planner that I deal with, and this was more theoretical, but it was to pay for these various plans was the dollar amount, which we're going to see in just a moment for the IRA and or the 401k, would shift from a set dollar amount to more of a percentage. But that would take away from tax benefit to pay for these programs. Okay. Moving right along. Before we move forward, any questions or comments on that? Jack, any questions or comments, please?
No, I'm good.
Okay, thank you. Mickey, any questions or comments?
All good here. Thank you.
Thank you. Good. Let's move forward. Now, tax rates, we'll go forward to page number 15. Here is the existing, as of 2021, capital gains scale, if you will. The 0 to 15 to the 20. And of course, it's based upon the individual's income and their tax filing status. Are they single taxpayer, married, filing jointly, or even head of household? Moving right along. Section 179, we've talked about it. You'll notice on this little chart on page 16 at the bottom right, I mentioned a little over 2.6 million. Well, it's 2,620,000 total property purchased. Okay. But the amount that can be written off, $1,050,000. In our example earlier, in the tax form in the 4562, we use 750,000. Moving forward, bonus depreciation we talked about, AMT we talked about, net operating loss, page number 19. It used to be you could go back 2 years or forward 20, taking that net operating loss. Then with the TCJA, the back 2 years was eliminated, but the forward 20, there were no caps. It could be 22, 25 years, whatever. Now fast forward to the CARES Act. Look at the very bottom of the page. You could go back 5 years. What? And recoup, because if the business has a loss in 2020, for example, because of the pandemic, wow, you could offset those losses against any gains or any profit, in other words, or tax going forward. Needless to say, the NOL, as I mentioned earlier, from a cash flow standpoint, most commercial lenders, it's not a positive nor a negative. But from a tax standpoint, because of the CARES Act, wow, total flexibility in the way the CPA or the tax advisor would advise their clients to take the loss. And well, wait a minute, we'll go back 5 years, recoup those losses and carry those forward. Absolutely. Moving right along. Lastly, page number 21, IRA deduction, 401k, and even for the self-employed, like we talked about. And then lastly, page number 22, the limitations for the HSA, whether it's self or it's actually called in the tax code family, self only or family. And you can see, of course, there's even a catch-up provision, age 55 or older, of another $1,000 in both 20 and 21. Okay. Now, with that, let's go back. Everyone, first off, before we leave Exhibit 3, are there any questions on Exhibit 3? Any questions at all? Okay, let's go ahead. If you put that aside, and I'm going to go back and I'm going to share back into our main PowerPoint. So if you go back to the main PowerPoint and go to the very end, so put Exhibit 3 to the side, and we're on page number 25. So we've done it, we've completed Exhibit 3. Now let's go to and do our quiz. Everyone on page 26 and 27. What I'd like to have you do is spend just a couple minutes on this. Go through and do the quiz, complete the quiz, and then we're going to review it as a class. So let's go ahead, take just a couple of minutes, page 26 and 27. Page 26, page 27. Answer these, do both pages, 26 and 27. And it doesn't have to be a big explanation. Some of these are just, one-liners, or just even just one number or one word or whatever. But go ahead if you would, please. Go ahead. Take just a moment on this. We'll come back together. And if you'll do both pages, please. Go ahead and take just another moment, and then we'll go through the quiz and do both sides, 26, 27. And then we'll start in just a moment or so. Okay, here we go. Dylan, what tax act changed the 1040 form extensively? Do you have that first? Go ahead.
Yep, the TCGA.
You are right on. Excellent. Okay, under Part B, Heather, how many schedules does the 1040 have in addition to A through F as of today? Not in 18, but 19, 20, and as of today.
3.
3, you're excellent. Matthew, what type of business would you have for the 1065?
Be like an LLC or single owner partnership.
Good, excellent. What about the 1120S, Matthew?
1120S, it's more, it's got, well, I mean, the notes I have are like double taxation. It's a larger business, can have 100 owners.
So, yep. So an S Corp. What about the 1120? What type of business for the 1120?
It's, I guess, look, I don't really understand your question. You can have like a regular business underneath all of them.
Yep, you could. But typically, the 1120S is for the S Corp. The 1120 is for the C Corp.
Oh, yeah.
You bet.
Sorry.
Okay, no problem. No problem. James, what does REIT stand for? REIT.
I have real estate income trust.
Good, close. Real estate investment trust. Good. All right. Alonzo, what is the maximum deduction under Section 179 today? This year we're in right now.
This year is now $1 million.
$1,050,000.
$1,050,000.
Yep, it was $1 million at the start of the TCJ in 18. It's ratcheted up this year, like we saw on that. We put in the form 4562, $1,050,000. Okay. Under Part F, Alexa, what are the current capital gains tax brackets? And there's only 3, but there could be a 4th coming up. If you can type that into the chat box, what are those 3? Okay, give her just a second. What are those 3? All right. Let's move forward, move forward. Jordan, what are those 3? Do you have that? What are the 3 for the capital gains tax brackets? Whoa, there we go. Jordan, Let's see, Septarshi, what are the 3 capital gains tax brackets today? Septarshi, Andrew, how about you? I know we've had some technical difficulty with the few.
David, I'm here.
Oh, okay, Septarshi, go ahead. Can you name the 3
Yeah.
under Part F? The 3 current capital gains tax brackets.
Yeah, David said right there, it's 0, 15, and 20, I believe.
Good, excellent. 0, 15, and 20, and it could go to a 4th, which would be 39.6%. Okay, great. Andrew, what does AMT stand for?
Alternative minimum tax.
Good, excellent. Page number 27. What's an example of a passive investment? Charisma, what's an example of a passive investment?
Would this be like a rental property?
Exactly. You hit it right on the head. Good. Thank you. Catherine Lee, what is one retirement plan?
401k.
401k, good. Joey Merlino, what is a DB plan? What does DB stand for?
Defined benefit plan.
Good. Which in this case, we talked about for the self-employed professional. The old-fashioned version would be like, United Airline, big, huge pension plan, or General Motors, or what have you. Okay. I'm going to ask Bob. Bob, if you'll type into the chat, what is a CRT? What is that? Bob, if you'll type into the chat there, what do we mean by a CRT? Okay. While he types that in, Catherine Walker, what is the annual gifting limitation in 2021?
Isn't it 10,000?
15,000. 15,000. It was 14 for many years. It's now 15. 15,000 per person. Good. Okay, back to that last question. Bob says charitable remainder trust, correct. Good. So CRUT for short, charitable remainder trust. That was the farm strategy we talked about. And then under Part L, the limitation is annual gifting is 15,000. Okay. Joey Hallman, what is the current inheritance tax exemption per person in 21?
11.7 million.
Got it. You got it. 11.7 million. And if it's a couple like Bob and Sue, it's basically 11.7 times 2 because it's per person. Good. All right. Graham, what is one year-end tax strategy?
Wasn't one of them the IRA stretching technique?
Good. Good. Jack, how about you? What's another year-end tax strategy?
I'm going to take Andrew because I thought it was a good one, having a child.
Oh, I love it. That's good. As long as the baby's born before 12/31, right? You bet. Excellent. Okay. Well, that was good. That was really good. Now, in conclusion, I'm going to ask each one of you, take just a moment, look back in your notes, think about it, and put it at the bottom of this page. What are just 1 or 2 takeaways from today's session? Things that will benefit you as a credit analyst, you as a lender, your bank, maybe even you personally, or a friend of yours, or a family member, or even, like I said, even personally. What is just 1 or 2 takeaways from today's session? Okay. 1 or 2 takeaways. All right. Then take just a moment on this, if you would, please. Look back through, think about it. Some of you may just, oh, this is the concept. Boom, there it is. You can even look back in your notes, look back in the main PowerPoint, presentation. You can look at the 3 exhibits and so forth. What is 1 or 2 takeaways? Okay, take just another moment on this.
David, this is Catherine Walker. I
Yes.
have an appointment at 3 that I have to go ahead and
Oh,
get
no
off.
problem. No problem. Great.
But thank you very much.
thank
Very
you.
informative couple of days, and I appreciate it.
Oh, you're welcome. Thank you. Bye now. Thank you. Okay, let's start. We're going to start with Mickey. Mickey, what is one or two takeaways from today's session?
Sure. One point that was discussed earlier that I found useful was really the underwriting discretion that's available, especially with some of these different community banks that most of us are working in. You referred to it as sort of creative underwriting, but just gathering some thoughts from some of the other members about different ways that their bank may approach different elements of underwriting. And I thought that was an interesting point and something to think about in terms of being able to justify different methods of underwriting.
Okay, good. Thank you. Dylan, how about you? Just one or two ideas, takeaways from today's session.
I'm curious going forward with the CARES Act allowing the 5-year carryback on the net operating losses going forward, how businesses might be reporting that in years to come.
Good. Okay. And that is new. That's flexible to where they can take those losses. What they do is they take those losses and offset against future profitability. Oftentimes what happens, and this happened back in the Great Recession, 2008, 2009, well, all of a sudden they paid in huge into the tax system in 05, 06, 07. They took the losses and they carried them back or carried them forward. They, in this case, carried them back. But in today, it's the losses from COVID they carry into the future. Good. Excellent. Heather, how about you? Just one or two takeaways.
I'm also going to say that just the different updates with the CARES Act, just to there again, see how everyone handles it when they complete their taxes and how they file everything.
Okay. Matthew, how about you? What's one or two takeaways from today's session?
I also liked hearing about the tax updates that might be coming. I felt talking about the 1031 exchanges was also useful. Do see that a few times with some of our borrowers, so that was nice.
Great. So tax updates and the 1031 as well. Thank you. James, how about you? James?
I like the part where talking about rental properties and sales of that. To move in and make that your primary residence for 2 years, and you can kind of dance around capital gains tax that way.
Good. Okay. Alonzo, how about you? How about you?
I thought it was useful. I'm going to kind of keep an eye on now, like you talked about the Schedule M1 and kind of matching that up with the company's financial statement or their P&L throughout the year to kind of just make sure they're not trying to be sneaky about anything.
Good. Keeping them honest. Good. Alexa, how about you? If you will type into the chat, please. And while we wait on that, if you'll type in the chat your one or two items, please. Let's see. I don't know if Jordan is with us. I know we had some technical. Jordan, if you're with us, do you have one or two items? Okay. And then we'll go to Saptarshi. Saptarshi, what's one or two takeaways?
I kind of found it interesting about Schedule D and how a CPA would look at it versus a banker when it comes to short-term gains and long-term gains.
Good.
On sales. And also Schedule B, if the interest is significant, if it's recurring, you'd add that into your cash flow and all that stuff. So that was pretty interesting to me. So
okay, good. So both Schedule D and Schedule B. Good. Thank you. Andrew, how about you?
Well, of course, I've loved all the PPP discussion with respect to forgiveness and then just general like cash flow perspectives, as well as some of the updates with the CARES Act. But I also enjoyed going through, just honestly going through the tax return piece by piece, because we're actually in process of switching one of our systems and how we actually develop our CAMs. So I'm going through and updating various templates and whatnot. So this has provided me a really great template so that I can go through and make some great edits to kind of how we do things and how we view things. So I really appreciate it.
Oh, great. Thank you. You're welcome. Good. Charisma, how about you? What's one or two takeaways?
I thought the capital gains, I don't want to say avoidance, but strategy for living there for 2 years. It doesn't have to be in succession of each other. You can live there for 1 year and move out for a year and then move back in. And then some of the structuring of like the LLCs and sole proprietorships, structuring of some of the businesses to avoid different things, especially like the auditing. I thought that was really interesting as well.
Good. Thank you. Catherine Lee, how about you? Catherine?
I like the conversation on using booked income rather to ordinary income because we do use booked income, and I liked how you discussed reasons to not use it versus using it.
Okay. Thank you. Now this is for Justin, Bob, and Jeff. If you would type into the chat, please, just your 1 or 2 thoughts, takeaways from today. And while we wait on that, once again, this is Justin, Bob, and Jeff. Joey Merlino, what's 1 or 2 takeaways from you?
Yeah, I really liked learning about the defined benefit plan and how that story you gave about the architect who can really contribute $200,000 to $250,000 a year. That really adds up, and it's something I didn't know about. So I thought that was pretty cool to hear about.
Okay, great, thank you. Now from the chat, this is from pardon me, from Bob. Clearing up the section 179 rules, discussion of what we might not include in the capital gains, also going through the various business returns, especially the S corporation return. Excellent. Thank you for that, Bob. Okay, good. Moving right along. Let's see, Joey Hallman, what about you? What's one of your 1 or 2 takeaways?
I thought that the year-end tax strategies and how there's different options for business owners was a very interesting conversation.
Okay.
Yeah, the money saving strategies and yeah.
Okay, good. Graham, how about you?
Yeah, I thought the tax strategy was super interesting as well, like for real estate or certain personal tax strategies that we talked about.
Okay, thank you. And Jack, how about you?
The best thing I thought was understanding the specific portions in the business tax returns, going through the different forms, because we deal with them every single day, and kind of just clearing up some little things on whether that's the section 179 or the interest or capital gains. It just was really helpful to kind of understand all of that.
Okay, great. Thank you for that feedback. Excellent, class. That was excellent. The feedback was excellent. Now, in conclusion, 2 thoughts. Number 1, if I can assist you, please don't hesitate. Send me an email. I'll glad to work with you as we started out the session. I mentioned that. Number 1. Number 2, tomorrow I will be providing primarily in the morning will be advanced C&I commercial industrial lending. We'll talk and discuss BBC, borrowing-based certificate, extensively. And tomorrow afternoon, advanced commercial real estate lending. So we've got those two sections that both in the same day, tomorrow morning, tomorrow afternoon. So I know a few of you will be joining us, but I encourage, if any of others would like to join, if you could rearrange your schedule, encourage you to do so. With that, everyone have a good rest of your afternoon, a good evening, and of course, a good weekend coming up. So thank you all. Thank you so much, everyone. Thank you.
Thank you, David.
Thanks, David.
Thank you.
Thank you, David.
Thank you, David.
Thank you.
Bye.
Thank you
Thank
so
you.
much.
Hey, David, you still around?
Yes, I'm there. I'm here.
You know, I got one quick question for you offline.
You bet.
I was going to ask this earlier. I figured I'd wait. I just wanted to know if there are any other relevant implications, positive or negative, regarding shadow owners outside of a decreased likelihood of an audit.
That's the main